Hit it.
It's Friday, January 8th, 2021, episode 113. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Cem Karsan from Untitled Capital Management. We have a fantastic discussion about SPX option flow, and he explains to us who this Vanna is that everyone's talking about. Then Kuppy's back. We go over his trades from the last year, and most importantly, he tells us about his new project, Kuppy's event-driven monitor. And no, we refuse to call it ED trading like he does. Then in Talking Charts, Patrick brings us up to speed on what the market tea leaves are saying.
And in This Week in Trading History, we go back to the oil spike of 1974, and then we end with our segments of No Stupid Questions and Skin in the Game. And, well, folks, we might even drink some beers along the way, so stick around. We've got a great show. Lena, hop on. What beer are you guys drinking this week?
So today we're drinking Whitewater Brewing Company's Class 5 India Pale Ale. So
Nice.
Don't let the smooth appearance of this Class 5 IPA fool you. The hidden dangers are only found at the point of no return when the intense bitterness of this seemingly calm beer hits the back of your tongue. A light combination of malted barley coupled with the citrus aroma of both Cascade and Centennial hops mean that Class 5 IPA is only for the experienced beer drinker.
Just the heads up, my buddy brought me this, a good friend. He sponsored the show. He dropped off a whole case of these, and the experienced beer drinker is right. This is definitely a unique taste.
Oh, and it says it's sessionably hoppy.
Okay.
Is that what it's? It's almost bitter.
Almost. It's like borderline. It's pretty hoppy.
Yeah.
But we'll save the beer reviews.
Unfortunately, I'm not drinking it. We'll get into that story in the after hours. But
he's on the wagon.
All right. Hey, Kev, give us a disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may includes index inclusion impotence, excessive speculation, and FOMOphobia.
All right. Let's get to our interview with Cem.
Well, coming up now is an interview that I've been looking forward to for a long time. Cem Karsan is from Untitled Capital Management, and he's been somebody that is quite knowledgeable in the SPX and the option square, and a lot of people have asked and told me how much they enjoy your comments and your insights, and I've been looking forward to chatting with you for quite some time. So welcome to the show.
Thanks for having me, Kevin. Good to be here.
So, when we were chatting earlier, we found out that we actually intersected our careers for a little while. I was at RBC, and I'll tell you a quick story. When I was a young kid and I was in charge of cutting up inventories, I remember cutting up the inventories for your group in Chicago.
Such a small world. It's crazy.
It is such a small world. So why don't you tell us a little bit about your background, how you got to that spot in Chicago? How did it come to be? Like, where did you grow up? What was your journey like?
Yeah. So my story is a little bit different than most, probably. Born in London, lived in Turkey as a child, came to the U.S. At a young age to Texas, to Houston, after junior high, my parents moved to Norway to Europe, and I went to prep school on the East Coast at a school called Andover outside of Boston. And incredible kind of experience for me, really changed my life. Really got into financial mathematics at an early age, and financial markets and public policy and kind of the intersection of all those things. And ended up going to Rice University and studying those, both policy and financial mathematics. And when I left, I knew I wanted to go into the derivative space. So Chicago was kind of a natural place. Ended up working for that group you mentioned at RBC Dominion out of college on the trading floor in the SPX, 1998. Long-term capital had just kind of transpired, was right before the tech bubble. So really kind of a unique moment in history and an amazing way to kind of start my journey in the derivative space.
For sure. You started at the two craziest years in probably decades.
Yeah. And it really informed my kind of view of the world, actually. That kind of coming in and learning right as long-term capital management had just transpired was, and then we had the Niederhofer kind of blow up, which some people kind of may know a little bit about. But it really had it made me realize the importance of tails and volatility in the markets, and understanding kind of sizing properly, the amount of convexity that ultimately exists in these products. And so, yeah.
Sorry, I didn't mean to interrupt, but I wanted, before you went on, a lot of people know the long-term capital management story, but I don't think a lot of people know the Niederhofer story. So why don't you just kind of sketch that one out briefly?
Yeah, so Niederhofer was backed by Soros, and it was actually maybe 6 to 9 months before long-term capital management happened, and it was kind of a precursor. It was he had made insane returns, about 50 to 60% a year for about, I think it was 4 or 5 years. Had become a dominant force, one of the first major flow players in the space, and that really dominated kind of market. So whereas before that, it was, you could really market make and not worry about getting run over. There were lots of different types of flows. He was so dominant over at the Merc that he really pinned markets and changed the way kind of players started playing in space. So when he blew out, he lost about 95% in late 97, early 98. He moved the whole market. It was a major event in the vol space, one of the first major ones. And it was kind of, like I said, a precursor, kind of a canary in the coal mine of long-term capital.
Right. Okay. So you're a young kid. You get recruited to go work for this group in RBC. Now RBC is kind of a strange firm to be down there, a Canadian firm in Chicago. But I guess the genesis of the group that you were with was actually from another firm. Why don't you tell us a little bit about that?
Yeah. So on the floor in Chicago in the late 90s, it was most of the groups came out of the most dominant group from the decade before, which was O'Connor and Associates. O'Connor and Associates was by far the most sophisticated group down there in the early 90s. It spun off a lot of other very successful groups like Wolverine, CTC, Chicago Trading Corporation, Belvedere is one that kind of came out of those groups as well. There's a lot of other big names, but RBC Dominion was basically these guys spun out, and as was want to do, a lot of these guys went off in small groups with backers, and RBC basically backed these guys. They were a separate division of RBC, so they weren't core to it. But all of the models, the interesting part is early on throughout the 90s and 2000s, all the major models that were used basically were derivatives of a model that came out of O'Connor, and a lot of the work that came from those groups. So there's more similarities today, in models in these equity products still than you might think, less diversity than you might imagine. So
can I ask you a quick question on that? You talk about the models being different. I guess a lot of people just assume that it's the Black-Scholes. Everyone uses that, but that's not the truth. When you actually go look at these market making groups, that you're using a different model. Can you talk a little bit about how that model differs from the Black-Scholes? Is it just a matter of trying to account for the fat tails a little bit better?
Interestingly, all the SPX is actually not, even though it's an equity product and it's cash settled, it's hedged exclusively with futures. All market makers are hedging their positions with futures, and so that cost of carry difference necessitates a slightly different version of Black-Scholes with specific adjustments. And as all these models do, that's just the first step. The key is, how do you model these surfaces, and how are you managing your distributions and your deltas? I mean, there are a lot of implicit assumptions in Black-Scholes, and the key is taking these models and adjusting them to compensate for kind of some of the incorrect assumptions in the distributions of both market move and vol move, not to mention skew move. So I think the core basis structure is the same between all of these. The changes in assumptions and the way these things are modeled has changed over the years. But it's important to note that everybody's still generally looking at the same structure, and I think that's the important part.
Right. Okay, so you're a young kid, you're working there, and quickly they realize that you actually know what you're doing in this SPX world. And so walk me through the next parts of your career.
Yeah, so after 2.5, almost 3, actually just over 3 years, at RBC, I had an opportunity. I was looking at the money I was making the firm. The founders of Belvedere were there with me before, Thomas Hutchinson and Owen O'Neill, and they had just left and opened up an opportunity for me to kind of move up into kind of the lead of that product. Made a lot of money during that tech bubble crash, and for many years there. And as a young kid, I started looking at how much I was making the firm and how much I was getting paid, and realized I could do a lot of this on my own. And left and started a group for John Mulhern of Old Liar Poker fame. He was running a Bear Wagner Specialist, which is a specialist firm on the floor of the NYSE. And he wanted to diversify away from the declining specialist business. And so he, having done a lot of options and derivatives, in the 80s and early 90s, decided to come look at potentially purchasing either CTC or Wolverine or a couple of these other groups at the time. And we, myself and a gentleman 10 years my senior, who happened to have a connection to him, and went and pitched him on the idea of building out the business for him. And we ended up doing that. We agreed terms, launched a separate arm of Bear Wagner Specialist, built it out to 20 traders on and off the trading floor, Amex, P-Coast, SIBO, Board of Trade, et cetera.
I have some questions about Mulhern, because for those who don't know, he was kind of a legendary figure. He traded way back when with Ivan Boesky, and in the famous Michael Milken. He was the only one of the few guys who went to jail. And the reason he went to jail is because he refused to give in and kind of snitch on anybody. And he was the only one of them that went to jail because he was so steadfast. He held steadfast to his beliefs. But one of the stories that I remember reading in Den of Thieves that made me laugh so hard was that one day in front of, there was a big risk arb decision, and everyone was waiting for something to come out. And he just decided to, he went out, and all of a sudden the stock started, plummeting. And Boesky phoned him up and said, "Oh my God, somebody knows something. The deal's not going through. And Mulhern said, no, that's just me fucking with everyone. I love doing that."
That was him.
So I want to know, was he like that? Was he seems larger than life?
He was. That's exactly the word I was going to use. He's larger than life. When you met him, he was exactly that. He wasn't, lack of a term, he wasn't quite right. Like all the most amazing kind of interesting people out in the world, they're all very unique and creative individuals. He was fearless, incredibly risk-seeking in a lot of different ways, but also very rational and a good quantitative mind. He was very loyal, very stubborn, as you kind of alluded to in that story. But incredibly unique man. Had a bit of a temper, but also generally used it at the right times. But an incredibly interesting fellow. Definitely not like anybody else I've ever met in my life, and I can tell you that.
I think you're extremely fortunate to work with him. I think he's one of those fellows that he's passed away since, but I would have loved to gone and drunk a beer and heard his stories.
He used to do some crazy things. He's very close with Bruce Springsteen. So Bruce would come through and play at all the kind of, Christmas celebrations every year. Again, I wasn't at the firm very long, but he would also fly, when traffic was really bad in New York, he'd fly, his biggest traders, in his private helicopter to avoid the traffic on a regular basis, just commute. So there's all kinds of crazy stuff. But,
larger than life for sure.
Yeah.
Okay, so you're there and you build this up, and eventually, what happens to that firm?
So because the specialist business went into decline, as he had expected, quicker, a little bit quicker even than he had expected, but fairly quickly. The equity of that capital, that business went from just over $1 billion to maybe 300-400. So the tradable deal that we had kind of spoken about of building the book out to 200 million in tradable equity never really came to fruition in the 2.5-3 years that we, despite our profits and building out the infrastructure. And so we were managed about $50 million of tradable leveraged margin, which is still a decent book, but I decided there was an opportunity for me to leave and take 5 gentlemen with me and really start my own market making group. And I did that in the equity indexes. I made it a bit more boutique, was focused around the CBOE in Chicago and CME Board of Trade. And we built that out back to another 15, 20 traders, and became one of the biggest market making firms in the SPX. We were 13% of the SPX volume at our peak in 2008, 2009. So one of the
was this
biggest.
before it was automated and before that it was all electronic, or was this actually when it was electronic?
It's still a hybrid marketplace. It's still open outcry in the SPX over the CBOE and the CME. But it did go hybrid before that. So it was already hybrid and electronic. But what happens in these institutional products, as you probably know, is it's actually preferential to institutional investors because you avoid kind of liquidity cascades and whatnot. If you're getting a really big block order done, to have kind of this, this open outcry.
Right. So I didn't realize that it's still that way.
It's still that way. The SPX is one of the biggest still used pits. It's maybe 300 individuals, maybe 250 or so now, trading. And again, one of the biggest volume products, obviously, in the world.
Look, can you just walk us through, like, when someone comes in and wants to do a big block of some SPX, are they generally doing it against futures? Is there some sort of mechanism to put it up against futures?
Yeah, so you tie. I'd say about 75 or 80% of order flow is tied to futures. When they tie it to futures, it's not actually futures. They tie it to combo. So a combo is obviously a synthetic future. So you tie it to a price, and then it's traded with the combos themselves.
So why don't you just explain that for people that might not get it?
Yeah, no problem. So a combo, a buying call, selling put would be a synthetic future because of put call parity that equals just long futures. So wherever the front month future is of the S&P E-minis, when they tie a product, it's automatically assumed that you're tying to that expiration month, and when it's all priced relative to a price level in the future. So any delta is tied to that level, and when it's quoted by market makers, it's quoted as such.
I can't remember our SBS. Oh no, they have to be European because they're settled into cash, so therefore it doesn't even matter. And the reason you do that is because it's on the same venue, and therefore you don't actually have to do futures. You can keep it all at the CBOT, right?
Correct, and not just because of the venue, but also there are cross margin considerations. The SEC is the CBO product is an SEC cleared product. It's an equity product.
Yeah.
And subject to OCC margin. So whereas on the future side, it's obviously CFTC.
Oh, I did
and so
not
if you're not a
realize
market,
that. So
if you're a market maker, if you're not a market maker, you don't get the cross margining. So any customer is going to want to have their hedge in the underlying.
So now, is there a designation that makes you actually a market maker? I didn't realize that there's
absolutely. So over on the CBO, there you have to be designated market maker. There's a seat leasing fee. You have to have a certain amount of in person and be held to trading. You have to have in person on floor, or you can have a permit to trade off the floor, but you have to be quoting a certain amount of series at a certain width at any time. So,
I didn't realize that. And then if you do that, you get the cross margining against the futures.
You can. Your clearinghouse can actually get the.
They apply on your behalf.
They can provide cross margining for you.
Okay.
So
and obviously that, because that's a liquid instrument that you need to buy and sell, that must be pretty important for all these guys.
Critical, because even though you tie up anything when you're trading it, obviously the gamma and delta effects, you're going to need to hedge with futures in real time. And there are a lot of live orders where you have to trade with futures. So,
right.
Absolutely.
Okay, so you're there. You have your own shop. You're doing 13% of the volume. What happens from then?
So had an incredible run from 2007 through 2010. Took putting the real numbers on it, like a couple $1 million, call it, and turned it in many multiples of that number. And had it in 2010. I had 98% of my net worth in that business, and the music kind of slowed down, and so I had an opportunity to kind of sell my portion, take a step back, and I was getting married, having a kid and whatnot, and enjoy the fruits of my labor. And I thought I'd take a couple years off. Really, I traveled for about 6 months. We had a kid, and then I was like investing my personal assets, diversifying some of the products that, some of the strategies that we used in the background of our market making operation. I turned into structured trades and was managing, call it $3 to $5 million in a couple of those products, and realized that they were all much more scalable and that there weren't any products out there in the asset management space. I'd always been a proprietary trader, so I'd never really run an asset management firm. But I kind of learned how to structure the trade, what people were looking for, and really went out there and raised some capital, developed a couple products. And now I run a firm called Aegea Capital Management, which is has a family of hedge funds and manages just under $250 million.
Okay, so I have lots of questions, but before we go, I want to go back to your market making, and I want to kind of understand, when you have these great returns, is that a matter of just smartly, having the customers cross the bid offer spread continually, or is that like a function of, on the whole, vol's overpriced in terms of on the index, so we're generally short? I just walk me through kind of where the big juice was on that trade. Where did your edge come from?
Yeah, so it's evolved a lot, right? And it also depends on the time period. I mean, a time like 2000s, there's a reason we ramped up so quickly to kind of that big a percentage of SPX volume, because it was like shooting fish in a barrel, right? I mean, during the financial crisis, there was a lot of liquidation. There were a lot of people having to kind of pay bid-ask spreads,
right?
And things really widened out. So during times of stress, things move much quicker. There's much more edge. There's risk, but if you know how to manage the risk and you're kind of sophisticated and have good models, you can really capture a lot of trading bid-ask spreads. So when I first started the business, the edge was consistently, the width of markets was, but maybe in an outright option was 70 cents, maybe $1 even when I first started, in the SPX. By the time the financial crisis rolled around, right before the financial crisis, it was probably 30, 40 cents in a calm time. But during something like the financial crisis, that widens out to $5, even $10 at some points, because very few people were willing to make markets given the lack of liquidity. So bid-ask spreads definitely matter during times of low stress, low volatility. That bid-ask spread is not really going to cover your costs.
Okay.
It really is a matter of most market makers will make their money in terms of bid-ask spreads if they don't have any structured positions that they trade in 1 or 2 months a year. That's the rest of the time is really paying costs. And in years where you have 3 months or 2 months that are really volatile, and you get some correction and some stress, those market makers will do very well in those years. And in a year where it's just 1 month or zero, like in 2017 and 16, they'll really a lot of them will bleed out and lose money. So, but that's for the less sophisticated, or I'd say the biggest market makers obviously have economies of scale. They have slightly better tech. They have positioning and other approaches that they would take. And there's other, obviously, profits to be made through quantitative strategies and positioning. And a lot of these market makers have obviously merged and become much more sophisticated and have become broad proprietary trading firms. So the line has definitely been blurred between market making and proprietary kind of trading.
So how much, gamma are they short? Or are they trying to keep that pretty? Are they trying to keep that pretty steady?
I would actually say, for the most part, market makers aren't necessarily short gamma. For the most part, they try and maintain a flat to long OEV exposure, or options equivalent Vega. From my experience, at least. Now that said, there are certain shops that are well known for being market making, but maintaining a certain amount of short exposure. Right. There are other ones that are known for market making and being, very short skew, right? Yeah. Like short downside versus long upside. And that's the one thing I would say, and I think this will eventually be important as we talk about kind of positioning out in the world and how that affects market movement. But market makers and dealers universally are short put, long call in the indexes.
Okay.
And that's just, logically the world is long the market, right, along the index. If you live, you're long. If you invest, you're long. If you have a job, if you're long the market, and if the market goes down, you don't do as well. So hedging in the indexes, and this is the biggest place to hedge equities in the world, is buying downside protection, whether it's a put spread or a put, and selling and writing calls, which is almost as important.
Right. So your argument is that at the end of the day, the customers are wanting to do that, and in essence, the market makers, someone's got to be on the other side of that.
Somebody's got to warehouse that risk.
Right.
Exactly.
And in essence, that is what eventually the market makers are going to be on the other side of those trades.
Correct. And to be candid, that's actually a very profitable trade. It's a carry trade, right? You're selling a much higher vol to buy a much lower vol. Right. And on realized terms, historically at least, realized versus implied, implied volatility skew in the indexes is very high and is very profitable. The problem is it's a carry trade, just like all other carry trades. It has a tail on it, right? Okay. And when people need to get out, everybody's got to get out at the same time, and it creates a feedback loop that creates even more stress.
Right.
But that is an important part of market making and dealer positioning, and it's a profitable source of it's a source of profits for almost all dealers.
Right. Okay, so let's talk about how you've taken that understanding about the positioning of the market makers, and put it into strategies where you can trade and in some cases even forecast what's going to happen in the market. Why don't you walk us through kind of, and did this come all of a sudden to you one day, or can you remember the point where you started to realize how much this was affecting the market?
That's a great question. So necessity is the mother of invention, right? And all the best, decisions are almost always come from some need. And the reality is almost all market makers, especially if you're 10, 13% of option flow, you have to understand how to lock in profits, right? And what I learned over my early career was that there's always bumps in the volatility surface. There's always excess demand for certain areas that creates what's perceived as edge, and then I guess relative value is edge for market makers and dealers. But the more you study that edge and how much of it you're able to capture, the more you realize that number is very low. When something's high and something's low, and you put it on and you put it in significant scale on, there's enough scale for you to put it. Ultimately, it's strangely, it never really seems to realize the edge that's on the sheets. And I think a lot of people, have realized this over the years. Very few have been able to verbalize and understand where that edge is going. What became clear to me early on was it was going into the underlying market. So the only way you capture that edge ultimately is for lack of a better term, front running or getting ahead of where the vol and underlying are going to move given that edge, right? And so when I say that ultimately means the delta or the distribution of the market is different than the broad assumptions, than a random walk, right? Given that positioning.
Right.
And why is that? Because when that positioning exists at that type of size, just like in all other products in the world, that means people have to lock in, right? As that position decays and moves away, right? Or that edge comes out of the marketplace. That position's got to be rehedged, right? And that is ultimately going to create flows that create reflexively a different underlying distribution.
Right.
So
let me just
that realization and that necessity to hedge those types of positions proactively led to the understanding of flows and how they affected the underlying.
So let me just see if I can put this in layman's terms. You would go, and let's just say a customer would come and say, I want to buy 10% out of the money put, and I'll finance it by selling 5% out of the money call. And you would look at that, you price it out, you'd sell the put, let's say at 30 vol, you buy the call, or you sell the put at 30 vol, you buy the call at 20. Theoretically, you should have 10 points of edge, right? Mm-hmm. And when you went to look at your P&L after doing this over many, many times, you would find that the actual P&L wasn't as high as the theoretical would dictate or would forecast. I
yeah, I mean,
right?
that's a simple example because you're talking about a specific, just a risk reversal, and that's great for simplifying it. But now imagine you have different puts over different expirations. So not just maybe it's a counter risk reversal swap. You have a risk reversal short in the front, long in the back, et cetera. Point is, it's not just a matter of the market going up, but it's a matter of the market going up at specific moments in time based on calendar exposure and whatnot. And I know that's probably complicating it for your listener, okay. But but absolutely, the point being is the market would ultimately move to remove the risk there, and because skew, like I mentioned, is universally dealers are warehousing short skew as a carry trade in the market. That creates positive index Vanna and charm flows. And those words I know some of your listeners may not know, but essentially the decay of over time, which is charm, of those underlying assets is going to create long short exposure that needs to be bought back. That's charm. And Vanna is as vol declines is the same thing.
So let's talk about those, because I think that as options have become a bigger and bigger force in the market, these are affecting it more and more. Would you agree?
Absolutely. And I think the understanding of this is becoming, I'm trying to help, communicate this to the world, especially on social media and whatnot. But the idea of gamma first has become, much more prevalent as you have a retail buyers uploading, loading into equity, single list equity names and having gamma effects to help push them up together. That's become more commonplace. I think these understandings of Vanna and charm flows and the delta exposure of dealers is less understood at this point. That said, I think they are having a greater effects, but they've always been there. All these things have always been there. I've benefited from them, profited from them, have been actively managing positions around these for over a decade. But I guess to your point, there is more volume in these options relative to underlying. So there is more of effect in that regard, but there are people that are more sophisticated that are front running them as well. Right. So it's kind of just like anything else.
So let's go through them, both of them one by one, and see if we can break them down and explain them to people. Let's start with the charm. Charm, is that what you call it?
Yeah. So charm is the delta, so the change in market exposure of a position per day of decay. So a day goes by. Let's say I had sold a 30 delta put to your or 30 delta put. A day goes by. Let's say there are only 5 days left. Maybe the delta of that, without the market moving, declines to a 25 or 20 delta. Right. That's just a function of time. The same and very similar and related is Vanna. Vanna is the same change in delta. But per change in 1% of implied volatility. Okay. With the curve in contango, which is what it generally is, Vanna and charm. The reason I talk about them together is you're getting a day of decay, which is charm, but you're also getting a decline in the implied volatility every day that goes by. So you're also getting some Vanna effects at the same time. Okay. So they kind of work together. They're related. Time and implied volatility aren't necessarily separate. And how they move. But those are the two kind of effects that create delta buyback in these skew positions or under events. And that's another thing we can talk about. They played a major role throughout this election process in the last several months. And they've been what allowed me to really make predictions about kind of the flow on the push up in the underlying indices during this period.
Okay, before we get to the election, let's just talk about in a standard environment as we approach, and it seems to be often that these effects, the Vanna and charm, seem to increase as we kind of get closer to expiration. So often, if I'm correct, that it ends up being that week before expiration, there's this gravitational pull with the high being the morning of expiry. And is that a function? And I must preface this is assuming the market isn't way down, and it's generally, it has to be that the dealers are actually long calls and not short the puts, right? Like it depends on where we are in the market. Is that not correct?
Correct. Yeah. So first things first, like full disclosure, like we measure open interest and flow. So we have a very, very clear sense of what positioning is like. It's not always as extreme. What I can say is generally, like when I say generally, like 99% of the time, dealers are short, put, long call in the indices.
Right.
That doesn't mean they're significantly short put, long call. There's a big variance in how big those flows are. But like you said, as those Vanna and Charm flows accelerate towards expiration, the amount of delta change in an underlying position, if you look at Charm, right, per amount of day increases as you get towards expiration, just like gamma increases as you get towards expiration. Right. So those flows become much more sizable going into monthly OPEXs that have the most open interest.
So that's why when you see those kind of incessant bids that don't seem to go away, that's increasingly the function of this Vanna and Charm.
That's exactly right.
Okay, so now let's talk about how understanding these positioning helped you in terms of the election. Why don't you walk us through what you saw and how you took advantage of it? So
the higher implied volatility is, especially as the curve gets into backwardation, the implied volatility curve gets into backwardation in the indices, the more, think of it as potential energy, right? The more of a possible change in delta, is likely to occur, and the amount of buyback, right, of flows is likely to occur coming when that volatility declines, right? Particularly that short-dated volatility.
Meaning that if it goes from 40 to 30, it's a lot different than from going from 20 to 15.
Correct.
Okay.
Correct. And particularly in backwardation, because you have the front of the curve at a much higher level. And to be clear, it's not just because of the size of the vol and the amount that's declining, but it's also, the reason the curve goes into backwardation, the vols go higher, is because they're buyers, right? It means dealers are, that's a clear sign that dealers are very, very short, right? They're backing off, they're raising implied volatilities, because it's going much higher, because there's fear and there's risk aversion, right? When you get large positioning at high vols, right, prior to a known event, rarely, if ever, do known events realize, regardless of the outcome, the fear that is expressed in the market. And actually, as I talked about with positioning, forcing the opposite reaction, almost always coming out of these market priced events, you get significant rallies. It's reflexive. Obviously, making assumptions like that is dangerous. I don't want to encourage anybody to always fade any known event ever, right? But the reality is, if you look at outcomes like Brexit recently, 2016 election where Trump was elected, 2020 where essentially we got a blue wave, all of these types of events were. And by the way, it was a contested election as well recently. All of these things were not expected events, kind of worst case scenarios as predicted, as feared from the market, right? And all of them were expressed with significant rallies in the market.
Okay, so let's just talk about this. Like going into the event, they raise volatilities because dealers or market makers back away from making offerings. Everyone starts hedging at these new higher levels, and then it rises to such a level that no matter what happens in the event, you're going to get a fall in volatility, which will therefore cause a bid in the deltas. Have I got it?
That's yeah. I want to be careful saying whatever, but but yes,
in essence, it gets priced so high that
an event vol, which is what happens. You have a discrete added implied volatility to an event, right? An event vol assumes an event. So after that event passes, the event's done, no matter the outcome, right? Whether it's positive, negative, whatever. The events happen. The knowledge is now in the marketplace, right? And the implied volatilities behind it, right, because of the backwardation, are now shifted to a lower implied volatility. That shift and that removal of an event vol, by definition, given the positioning, unless you get a big enough event, and given the high volatility, it's very hard to realize those events, right? Unless you get a high enough realized volatility to make up for that implied volatility, will create a buyback of delta based on Vanna.
Right.
And not just a little bit. In those events, given how high they are in the positioning, dramatic buyback. And they only increase as you get closer and closer to expirations. It also generally, because of that positioning by dealers, is not just short put long call, but it's long calendar put spreads because the curve is in backwardation. And as seeing as dealers are that way, they get longer and longer volatility. So that's a Volga effect, which is a whole other Greek. That's not a delta exposure, but that's a vol exposure. Dealers are getting longer and longer implied volatility after the events because the things they were short at a much higher vol, right, are disappearing and they're decaying long into what is left at a much lower vol.
Right.
So you get more and more vol compression because dealers are longer and longer vol. You get more and more delta buyback. The two feed on each other, and ultimately you get significant support and then rallies in the market post event.
So without giving away too much of your secret sauce, how do you structure trades to take advantage of this?
Well, so what needs to be understood is this is somehow, by some people, this is interpreted as markets being efficient, right? And I guess you could kind of claim that markets are efficient. It's hard to make money on these positions when something's high and something's low. My view is not that the markets are efficient, that they're reflexive. It's a kind of a different thing. It's very hard to capture profits because of positioning, because there's a reflexive feedback loop that creates supply and demand flows that make it hard to do that. Once you understand that and you look at the world in that way, you can see that there's edge in the positions that you're picking up. The edge is real. I'm not saying the edge isn't real, that it's the market's efficient. So putting on those positions is profitable. The key is understanding the flows that are coming in and making sure that you are realigning your distributions of market move to align with the effects of an underlying bid in the market under these conditions. And I think once you take that type of a view and you redraw your distributions, you understand the factors that are at play and the flows that are at play. Given these effects, you're able to put on profitable positions and then actually remove that profitability from the marketplace.
So let me get this right. So, the Black-Scholes assumes a normal distribution. We all know that the tails are fatter, but apart from that, there's very little else that's usually done by kind of the layman, let's just say option trader. Are you saying that if you actually kind of put in a different distribution expectation and therefore price your model based upon that different distribution and therefore have option positions that are, designed to take advantage of that different distribution?
Yeah.
Oh, okay.
Basically.
So you stick it in. So now you just how do you do that? Is it like a binomial equation? And you can actually put in your own distribution and then figure it out? What the price should be?
I think I'll leave it there. I don't think we have to dive into the exact, if you don't mind. I don't want to dive into
too much secret sauce. I get it.
My model, but I think that's enough for any educated kind of vol person to kind of take from there and do it in their own way. I mean, you can also, I'll say this, you can do it one of two ways. You can change your deltas based on that distribution and really kind of manage your volatility independently. Or you could really model your whole volatility pricing,
right,
based on those distributions.
I get it. So listen, while I've had this theory, and I'd love to kind of toss it out there and ask you what you think about it. I've thought that in the old days when we used to trade, in the 90s and even in 2000, the market wasn't quite as 24 hours as it is today. And when I think about, how you go about pricing an option, one of the things that's, implicit or in that kind of equation is the fact that you have continuous markets. And we all know that there aren't continuous markets yet. Now there is. Do you think that the market makers are a significant factor in terms of these overnight moves? And if so, do you think that this has actually made it so it's easier for them to price and maintain their hedges, given the fact that these things trade 24 hours?
Yeah, I think to some extent. I mean, it hasn't been it isn't something that just started, right? This has been evolutionary, not revolutionary,
right?
And even though markets are quote unquote traded 24 hours, they're not liquid for 24 hours.
Okay.
Even though you can get a price, like if you're trying to trade any real size, good luck, at least in the vol space overnight. But to your point, I think it's a very valid point. The structure of the markets and when liquidity exists is given these assumptions of volatility, decline, and the buyback that needs to happen, compensated for it, really do inform timelines of when you can expect buybacks in these deltas of Vanna and Charm or gamma exposure. Again, I don't want to just focus on Vanna and Charm, but the hedging rehedging of portfolios, or the front running of the rehedging of portfolios, which is increasingly happening, needs to happen under the assumptions of some liquid understanding of what's happening to volatility, if that makes any sense. So as Europe opens, I won't get too deep on this, but as Europe opens, which is the other major vol market, right? You have kind of the opening of a liquid vol.
I get it. So you're saying they don't want to do too much, because if they do too much in vol moves, then they could be finding themselves, having to hedge again. And so
that's right. So banks and big, buy side firms need to rehedge their positions. They realize that, but they can't really, make a strong assumption on what's going to happen to volatility or the market, right, until there's more liquidity. They can start to, but it's risky, right? And there's very little liquidity given the size of these books. So as the window for liquidity opens for these trades, and there's a better understanding of where vol will be priced or where the market will be set, or even now front running that a little bit, people have a better sense of where that's going to be and try and take advantage of that. Then you start to see these flows really kick in aggressively. And so there are windows of time, which, given that, banks and big warehouses of risk are generally doing this at the open and close of trading, right? There are kind of windows leading up to those that people are kind of trying to front run those flows.
Right.
Those, but again, the market's not really 24 hours. It really has specific open and close times. There are, overseas markets versus here markets, which affect each other and are important.
But you don't think that people that are short gamma are chasing their gamma overnight?
There's definitely some of that going on. But again, I think these Vanna and Charm, these flows to day forward or change in implied volatility, which is 95% of the time, the gamma effects tend to be much smaller in the indices than in 95% of scenarios. Yes, you have 1 out of 20 days, right, which you have, making up a number, a big move where gamma kind of is what matters. But on your average day, gamma is a much smaller effect ultimately than the delta buybacks that exist from just move of the day forward and move of implied.
Oh, I didn't realize
that. Those flows and the timing of those flows are a bit more predictable as well. So
in terms of when dealers like to do them.
Well, ultimately, you have a better sense of the general positioning, and you understand that exactly that people have to do it. It's a function of like time goes forward, right? Yeah. One way or another. You know which way time is going. You may not know where the market's going, but you know which way time is going. And if the curve is in contango, you also have understanding of where implied volatility is going.
Right.
In a decay scenario, the implied volatility is also going to trend lower. So those things are things that you can lean on and that are well understood, and that if that time moves forward, you have to, there will be a certain effect on flows.
Okay, so
that makes it traditional.
I'd like to just understand this a little bit better. So we know the charm I can get. Let's talk a little bit about the Vanna in terms of when the implied's moving around, how quickly it might affect the deltas. So if we get a situation where we get up in the morning and market's up and all of a sudden implied's down, let's call it 50.5%. Do the people, or do the hedgers or the market makers generally go and reach for that delta like within the first half hour, or is there any sort of like guideline?
Yeah, dealers tend to be more sophisticated. When I say dealers, I guess that there's a lot of different. I'm thinking more market makers,
Okay.
right? But they aren't necessarily the ones warehousing all the risk. A lot of the bigger warehousing of risk is at banks, right?
Oh, I get it. Oh, so
And
you're saying the
in terms of
really
structured
big
products,
positions, the really monster ones, are sitting at Goldman Sachs and J.P. Morgan.
Right. So and hedging those portfolios doesn't happen at or for the most part doesn't happen at 1 a.m. or 2 a.m,
Oh,
right?
okay.
But that on open and close that every bank desk trader has to have their book rehedged, right? And if they're not, like the global book is probably rehedged, right? So, and it's not just banks, but I'm giving them as an example. Ultimately these portfolios are being rehedged on kind of an open close type scenario. And so that leaves a room for people to understand that those flows are coming and to, as they have a better sense and are able to kind of hedge and manage vol exposure, they're able to kind of get ahead of that.
Okay.
And so you see 1:30 to 2 p.m. Central, or people start front running those flows. It depends what time and exposure and what's happening and the perception, right? But that creates end of day kind of support in these scenarios, and then you also see kind of when you're an hour before your opens, you kind of see something.
Okay. And in terms of when you see a situation like an anomaly, you have the market rallying, you generally expect the implieds to be coming in, and yet they're going up. Why don't you walk us through what's most likely happening? Is that a big customer that's moving it, or is it no one that big and it has to be the market as a whole is nervous about risk? Like, what does that mean when you see them kind of not coinciding in terms of those two traditional relationships?
I'm sorry, I'm not sure I understood that.
So you get the market ripping higher, and let's just take today for example. Like we had not today's not a good example, but there's days that the market rips higher, and you generally would see the VIX and the implieds coming in, and instead you see all of a sudden them go. They start to rally. So
yes, correlation breaks between vol and the market. Yeah, so for the most part. I don't like to look at, and I think it's, even though most of the world does it, just looks at VIX and VIX curves. I think they're very deceptive. I think the best way to look at implied volatility is to understand fixed strike vol.
Okay.
It's actually a much more robust understanding of what's actually happening for most institutional flow in the market. And what I mean by fixed strike vol is, how is not just because what the VIX does is it ultimately looks at the money versus at the money. Most of the volatility market, the S&P and all equities are pricing an options volatility curve, which has a skew assumption. So if the market goes up 5%, you're going to slide naturally to a much lower implied volatility. The implied volatility of that higher, call is much lower than the current at the money. So, naturally you'll slide to a lower implied volatility, or the VIX will decline, even if volatility itself has not actually moved at all, and vice versa. The downside, if the market drops big, you could see a spike. You'll see a spike in the VIX, but in reality, implied volatility might even be coming down if it's big enough.
Okay, wait 1 second. Can I interrupt there? Because actually, I don't understand the how VIX is calculated well enough. You're saying that midday, as it's moving around, it's using different strikes to calculate the VIX?
Yeah, so
I didn't realize that.
Back of the envelope, without getting into great detail, is the VIX is priced surrounding the at the money, right? It's a series of options formulated to calculate an implied volatility level by taking in a strip of options across the marketplace centered around the at the money, right? So as the at the money drops, right, as the market drops, the implied volatility curve, the smile of the options 30-day out, has skew to it. The downside is a much higher implied volatility than the upside. Right. So, if we drop, naturally the implied volatilities will increase because the at the money vol path is higher, right?
And this
might actually not decline, might not increase at all. The market could drop. The more you drop, the more expectations of higher implied volatility are. So you may get a situation where the market drops 5% all of a sudden, right? And you slide from a 20 vol to a 35 vol, but the VIX may, the implied volatility that's actually where things are trading may, for some strange reason, because supply and demand, only be 30.
Ah.
And so even though you see the VIX go, from a representative 20 to 30, right? In reality, implied volatilities might be getting crushed, right? So it's not a fixed strike vol is a much more realistic view of supply and demand in the marketplace and what's actually happening to implied volatility. It's relative to expectations and positioning.
Okay.
Prior to the move.
I get it.
So it's important. The reason I bring that up is it's important to take that perspective first, because it's really hard to weed through these correlation breaks, what's happening to VIX and vol relative to underlying, if you don't first see kind of what's actually happening in vol as opposed to kind of this VIX number.
I get it. Right. But
having said that, it's very, when you do see correlation breaks between the VIX and the underlying, if you see a situation where the market's going up and the VIX is going up, or vice versa, that tells you how that means a lot, actually, because for it to even come close to that, right, there has to be a significant increase in implied volatility because you're naturally sliding to a lower implied volatility upside, and vice versa with the downside. So when those things happen, they are big signals. Even when they outperform relative to trend, they're big signals relative to the fixed strike. They what that tells you is that you're sliding to too on the upside. That tends to mean you're sliding to too low in implied volatility. That the pricing of the implied volatility upside is too low, so you're kind of breaking out in that situation. And that means there are buyers at those levels. And when that happens, that tends to support a change in trend of volatility and a buyback. Because once there's support and vol's too cheap to the downside, all dealers start getting taken out of any long vol they have. They start getting forced short vol, and that can create a real bid to vol, which can then reflexively push the market back down, right? And so there is not only is it a signal of you kind of reaching a top, but it's also reflexively creates flows that can then have opposite Vanna effects, right? So if implied volatility starts getting pushed up because the vol's too low, then you start seeing selling in the market as opposed to buying, which can then force the market down very quickly. So all these things are related, but that's part of why when you see correlation breaks between vol and underlying, it's an incredibly good signal to use in an array of different signals.
So one of my my readers asked me to ask, he's a big follower, big fan of you, and he says, "What's your process in terms of on a daily basis? What are you looking at to come up with all your voodoo magic here with all your levels and stuff?"
So there's kind of two big things that I think everybody appreciates, so they get the most out of it. There are daily levels, right? And then there's these kind of this broad concept of Vanna and charm flows. The two are actually, they inform each other, but they're very kind of separate things. All the Vanna and charm stuff I talked about really helps me, helps us focus on how to be positioned and underlying distributions and how those are different probably than what the market expects. So that's broad positioning. The levels are obviously help you figure out where the points of friction are, where you're most likely to get people coming in to buy or support the market, or if you break it, where it's really relatively good chances of it kind of cascading lower or higher. So I believe this question is about the support and resistance levels specifically. Those are a function of similar to our models of not just Vanna and charm, but also technical factors. So we do look at traditional kind of volume technical factors, but we complement those with open interest understanding and positioning understanding, gamma positioning, to understand kind of where there might be more people, dealers might be more likely to buy or sell to support, to hedge their gamma position. So it's really a confluence of multiple different kind of factors, and together pretty powerful. I think a lot of people have been kind of shocked by how good you can kind of pick general areas where flow will kind of hit tracks. But I think if you combine this understanding of directional bias with these understandings of entry points, exit points, it becomes a pretty powerful combination.
Okay. One of the things that I like to ask our guests is, for people that are getting into the industry, it's changed a lot since 20, 30 years since you and I have started out. What would you tell a young person that was interested today? Like, what would you tell yourself if you were transported and you were 20 years old coming out of school today? What advice would you give yourself?
A couple things. I think one, don't worry about how much you're getting paid day one. Find somebody who has a lot of experience, who, a mentor and try and pay for knowledge. Work as hard as you can. Give them all the energy and work that you can and in compensation for knowledge and experience. I think I got a lot of that early on from several people, that's worth way more than any early compensation. So always try and don't worry about names of firms as much. But obviously, you want to work somewhere where they have expertise, talent, knowledge, and people who can mentor you through the process. That's one. And then secondly, I'd say never assume. I think early on, everybody starting out says, "Oh my God, so many people know so much. I'll never kind of know X, Y, Z." I think one of the most undervalued things in this world is creativity. I think be willing to come up with your own theories, your own ideas, test them, try and break things that are assumed. I think that's one thing that served me incredibly well. I think and the people that I most respect in this business have been willing to really challenge what are otherwise assumed ideas and pave kind of their own path from the knowledge they've gained.
Okay, so that's great advice for the youngins. Now for the oldins, the gray hairs or the no hairs like us or like me, what would you think is going to be the big surprise of the next, 5 years, 10 years on the investing landscape? And is there anything that is you feel and advice you would give people today in terms of things to watch for or kind of surprises that might come out of the blue that you're more on the lookout for?
Yeah, I've been pretty vocal about this. Starting about 6 months ago, I think before anybody else, honestly, about kind of the move from monetary to fiscal, and with a blue wave, or even without the blue wave, just broadly, that's kind of with greater populism and battling kind of perceived inequality in the world. This is more of a macro thing than a vol thing. But I think it really affects the vol markets and underlying markets in dramatic ways. We've been in a 30 to 40 year cycle of monetary dominance and supply side economic dominance, which has created lower and lower interest rates, a deflationary environment with relatively low economic growth. I think we're about to see a reversal of that, and I think that has dramatic effects on underlying markets, on volatility markets, and the way these things have traded. I think there's a complacency in the market at this point we have had no inflation because it's been a deflationary environment, for a very, very long time. And I think people assume that inflation can't happen. And I really think higher long-term rates, as well as kind of, tied to this inflation, as well as higher economic growth, actually, which you would think would be positive, but is actually quite, it could be a potential problem in the short term over the next 5 years, even 10 years for financial markets. I think we get multiple contraction. I think we get, this isn't doom and gloom. I think we get great economic growth. I think we do start to see a stronger kind of middle class and more demand side economics. But I think that pretends very, very different dynamics than we've seen. So if you're modeling things from a quantitative perspective, or and the reason I think these macro things are important to anybody, especially if you're managing quantitative, the models from the last 30 years, I don't think will apply as much to the next 20.
Okay.
I really think we're amidst quite a regime change.
I have to tell everybody that I did not know that was going to be your answer. And we did not set this up because, Jim, I couldn't agree with you more. I completely agree. I've argued that the COVID will turn out to be the 1981 moment in reverse. In 1981, monetary took over. Volcker broke the back of inflation, and we ended up spending the next 40 years or whatever that ends up being focusing on monetary. I think COVID will prove to be the opposite, and I completely agree with all your analysis. The one thing I will ask you, though, how do you position your portfolio to take advantage of that? Is that, in essence, mean that we should be longer vol, the long gamma?
So my view is that this affects flows. Again, now we get back to flows, right? In three different ways. One, the most broadly understood is discounted cash flows, right? The higher long-term interest rates are, the more growth names, right? Things that are looking at longer periods of time for valuation justification get hurt, right? So I think that informs a growth to kind of, for lack of a better term, value. I hate to call it value because that means a lot of things to different people, but more kind of quality discounted cash flow businesses versus kind of these high multiple growth names get really hurt by higher interest rates. And so that would force that shift in valuation. I think also second of all, the fact that higher interest rates would ultimately unwind the TINA effect, so that there is no alternative. I think an unwind of that TINA effect is highly likely with higher bond yields, and so that's very bad for multiples. And we've seen, again, higher interest rates are well documented as causing lower multiples but most people think of it through the prism of discounted cash flows. I really think just as big as the supply and demand kind of change because of the TINA effect and the shift of other alternatives. And then lastly, higher inflation, higher interest rates puts the Fed in more of a box. The Fed has had this virtuous cycle now for 20 plus years, call it 30 years, because they're giving money essentially to corporations by lending money and wealthy individuals. That creates more innovation in the sense of globalization and lowering cost of goods, AI, technology, investment, and those types of things. So that ultimately is deflationary, both technologically in terms of globalization, and also in terms of cost of capital. All of that is deflationary. At the end of the day, you have something that's more inflationary. The Fed cannot keep interest rates lower. They can't stimulate in a stagflationary environment. They have a very hard time lending more and creating higher and higher inflation. So that will decrease the mean reversion, which has been at all-time highs of the market. And so you ultimately you raise implied volatility with higher rates, you decrease mean reversion, the market becomes more trending. You decrease multiples through a TINA effect and a flow of capital back to bonds and through discounted cash flow. So all of these things point to the same direction, right? We are heading towards a more normal for us old folks market, and not this kind of Frankenstein growth at all costs, free money environment. So as we head towards that, the old rules begin to apply again, and it's not going to happen at once. But we are at the tip of the iceberg now. You've seen an incredible run from September till now on the back of this and the beginning acceptance of this. I think there are passive structures or passive flows through all these ETFs and the Vanguard type funds that are tied to growth and momentum. Momentum via growth, and I think the more growth falls out of favor and the more value performs in the years to come, momentum will actually belong more to value names. I actually think the passive headwinds that value has structurally faced will also turn and to begin to support value eventually. So there's a lot of positive tailwinds to value. It sounds crazy to talk about value after all these years. Everybody assumes it's going to mean revert and get hit again, right? But I think there's real reason for it.
From your lips to God's ears. Okay, I always like these Chicago guys. I know you were drinking a beer with us while you're doing this. Tell us what you were drinking.
Absolutely. This is Revolution Brewing. So Fifth City, it's the Chicago Pale Ale. So
nice.
Representing the tribe.
And is that your go-to beer?
It's one of them. I got some other ones as well, but Revolution Brewing puts out some great stuff. There are a lot of great microbrews in this city.
Well, listen, thank you very much for your time. Why don't you tell people where if they're interested in learning more about what you do and following you, where can they reach you or follow you?
Yeah, so play on my name. It's at jam_croissant on Twitter. That's pretty active there, and put a lot of this stuff regularly, daily out on Twitter. And, our funds are at Aegea Capital, AEGEA capital.com. We're in the process of a merger with ARB Capital Management. So I've also listed those. There'll be more information come out about those in the months to come.
Well, thank you very much for your time.
Awesome. Thanks for having me.
Well, it's been a while, but we're pleased to welcome back to the show Harris Kupperman, Kuppy's Corner aficionado and an all-around terrific trader. Harris, great to be with you today.
Hey, thanks for having me on, guys.
So before we do anything more, I just want to chat about what a great year you had. And there's been so many different stocks, I don't even know where to start. I guess the one that you really nailed on the show that was, the Market Huddle appearance actually ended up being the start of the bull move was St. Joe's.
Yeah, I mean, I don't know. I guess you guys have a lot of followers lately. What is this, 130? What are you, 130 episodes, 133? I guess a lot of people listen to you.
Well, I think they listen to
They
you,
listen
buddy,
to-
not
exactly.
us. Not us. The gap higher, it gap and ran, and that gap that you see was you on the show talking about it. It's been a terrific trade. Well, why don't we just kind of quickly update? Do you still like it? You think it's headed higher?
Oh, absolutely. I haven't sold a share. I mean, I'm actually kind of pissed off it ran. I was pretty much all the open interest in the 18, 19, and 20 puts. I thought I was going to get assigned on some more.
You were selling those to get long, and unfortunately it took off with you without getting you long.
Yeah, well, I mean, I guess I'm part of the reason it took off, but I guess I should have timed it a little better. But anyway, it's a very full position for me. It's my biggest position. I think the shares are worth well north of 100 today, and that value is increasing very fast. The demand for housing in the Panhandle has just gone parabolic. Days inventories, collapsed. It's under a month. Property prices in the Panhandle are going parabolic. This is the way to play that. And, it trades at like a third of the net asset value still. And I just think it's going to be a great trade. I mean, it's backed off the last couple of days because interest rates. But, in the end, if, a mortgage is 4% versus 3% or 2.5%, I don't think it changes anything really. People want to leave big cities and go somewhere pretty with low taxes.
Let's talk about some other ones that you nailed. Sandridge was a big one. We finally got that thing up to life.
Yeah, it got up to $4 last week. Sandwich is funny because I think every show you guys asked me about it, it sat there at $1.25, and you couldn't give the thing away. And I walked everyone through the thesis. It must have been 5-10 times, and finally the price of oil started going up, and everyone goes, "Oh yeah, it's trading for less than cash."
And isn't that just the way trading is, though? How a lot of times with these things, you don't know what the trigger is going to be, and you just have to. Cheap stock can stay cheap for a long time, and then all of a sudden, almost overnight, it gets people wake up to it, and it gets repriced.
It's kind of crazy because they have north of $2 a share in cash. They're probably going to earn $1 or $2 this year at current energy strip, and it trades at 3.5 today. It just doesn't make any sense. It should be $5, $6, $7 already.
It makes more sense than it was at $1.50.
That's trading, guys.
So speaking of trading, another one that you've nailed that I've been just hugely impressed on, because not only have you nailed it from being on the long side, but you've been the first to admit that you're not even a believer. This was a pure trade, was the crypto frauds. And you have consistently come on our show and talked about different things. I think Galaxy was one of your first that you brought up way early. That ends up, I think you started telling us about that at $1. I looked at it today. It's ticking at $11. Mira, Riot, Hut, all you name it. You were in these things. You were early, and you did a lot better than me in terms of hanging on. Geez, do you think we're near the end?
No, Bitcoin's going higher, and these things are proxies for Bitcoin, and they're going higher. Of course, I sold too soon on all of them. When you think back to like March and April, I was buying shares of Galaxy for less than the crypto assets they owned. It was the only time in my life where I could say it was sort of a value investment in crypto.
You were a Benjamin God disciple there, were you?
Yeah, I was buying Bitcoin at 60, 70 cents of the dollar, sitting inside of a shell. It was kind of funny, actually, when you think about it. The only other guy buying was Novogratz, who was buying pretty much every share that traded. So I was in good company. But, I sold that at about $4, and I was pretty proud of myself. And, that it tripled because I always sell too soon. And the same with Mara and Riot, which are, blatant frauds run by criminals. Hut, I think it's sort of in the middle. I think they set it up to be like a stock promote, but then they actually got good at mining Bitcoin. They call it mining Bitcoin, which doesn't make any sense because it's like a computer. But anyway, no, these were great. They're multi-baggers. I owned some MicroStrategy for a bit. I still own all of my Grayscale. I have not sold it. I am amazed at what it's done. I assume it's just going to keep going up 10% a day because that's what it seems to do. But no, Bitcoin's been very good to me. I don't understand why it has value. I feel pretty strongly that in 5 years it'll have no value again. But if there's going to be a giant global Ponzi scheme bubble, you might as well participate.
Right. Now, the other one that, I'd love to talk to you about, Harris, is this shippers. And early on, you came on and you were really bulled up on those. And, they didn't go, they went up for a while. You were a trader, you're in and out. And then they got weak and they kind of came in. Let's just pull up Sting or something like that. And,
Sorry.
Yeah. No. And one of the things that I remember talking to people about is that everyone was focused. You would come on our show and they'd say, ask him about the shippers, ask him about the shippers. And I'd be like, why do I want to ask him about the shippers when there's other stocks that he's trading that are actually moving and they're going the right way? And one of the things that I'd like to just kind of highlight for a lot of people is that Stanley Druckenmiller, which is generally considered one of the greatest traders of all time, if not the greatest trader of all time, he once calculated his batting average. His batting average is 60%, meaning that 40% of his trades are wrong. And, I think that you ended up making money on this, the in and outs and trading it around. But let's just say that it didn't live up to your expectations. But one of the things that I just like to kind of remind people is that you're not going to get them all right. And, you should fall in love with your partner, not with your position. And I found that people were probably more in love with those than you were, and you had already kind of driven on, and then people were still stuck in talking about them. And so one of the things that I just like to highlight is that make sure you diversify and you look at all these different positions that you're talking about, because you missed a lot of great opportunities if you were stuck talking about tankers. Now, having said that, what do you think about them here? They finally seem to come to life.
I mean, they've come to life a little with energy, but in the end, I didn't get it right. I don't know if I got it wrong because I made money, and there's nothing wrong with making money. But I had a thesis about IMO 2020, and I didn't expect that COVID would come and global energy demand would collapse. And you see where the energy supply side has dropped off. It's OPEC. And OPEC oil tends to go on tankers. So, the demand for shipping oil by tanker has just collapsed. And, it's been off now for 9 months. And, that killed my thesis or postponed my thesis, however you want to think about it. And, when you're out there and you see what's happening in the world, you got to adjust when the facts start changing. I thought we'd either have a situation where you'd have super contango last forever, and it lasted about 3 months, or you'd have a situation where demand came back. And instead, you're kind of stuck in this like middle range where tankers don't make any money. Yeah. And so I accepted that and moved on. But you had 2 opportunities there to basically double your money from my initial call. And there'll be another great opportunity in tankers sometime probably next year. But in the meantime, I moved on. I didn't sell enough on when they were up. I added a bunch back in March, February, March, because I saw the super contango coming, and I caught it just right, and I took some off again at the top. But I rode a lot of it back down. I kind of round tripped it twice. But when I tossed them all this fall, what I did do is cycle into a company called Dorian, which is also a tanker with a lot of the same dynamics in play, but is for propane. And it's been very good to me. I've basically doubled my money on it. I bought a ton of it in the 7s and 8s, and here we are today at 14.5. It's my remaining tanker position. It's been very good to me.
Okay. Well, let's talk about the last one that you got right, which was Dillard's. You came on the show and you talked about how there was a potential for a squeeze, and man, oh man, did they squeeze this.
That was quite the move.
Yeah, it was kind of nutty. I mean, I didn't expect that what's his name from Berkshire would end up buying a filing position, but I was out before that happened. Look, I do a lot of event-driven trading. I don't talk about it too much because it's kind of hard to come on a show like this and be, hey, I'm in this. I might be out of it tomorrow. I might be short it tomorrow. But there's a lot of these setups you see where you could do something that's very actionable. It's really driven by fund flows, or it's driven by some sort of like strategic corporate action or something like that. And in the case of Dillard's, you had pretty much more shares short than shares in the float, and the company was buying back stock. You knew it was going to solve itself at some point, and when you saw the borrow rate spike, you knew that was go time. And I wrote to my readers about it on my blog, Adventures in Capitalism, and about a week later, the shares went parabolic, and we made about 50% in about 2 weeks. And you don't have to do that too many times to have a really great year, especially when you play it reasonably large. A lot of the event-driven stuff I don't play too big, just because you're playing the laws of averages. But this one I felt pretty good about, and I kind of leaned into it.
Okay, so let's talk about that. You mentioned your strategy, you call it event-driven, and you have a new kind of venture, and it's it's KEDM. And why don't you tell us a little bit about it?
Sure. Let me give you, I guess, a little story, kind of how this came about, because it won't make any sense otherwise. I've been trading event-driven stuff for my whole career. There's always something to do. And, for a lot of this time, I'd build a spreadsheet and then I'd, stop tracking it, or I'd build another spreadsheet, or someone would email me things. I'm so lucky that so many of my friends are real smart and they flag stuff for me. But I was never really systematized. There was never really a process behind it. And this spring, when event driven really started working, and I mean like really started working, I said to myself, I need to systematize this. I'm missing too much. You know that feeling where you're like, oh shit, that was this week? What?
Yeah.
And
Sure.
I just kept having that feeling. And I said, I have to systematize this. So I hired a good friend of mine and basically said, here are the 20 or so strategies I track. Let's build spreadsheets. Let's track this stuff. And as soon as he started doing that, I realized just how much money we'd left on the table for the past decade, quite honestly. and we just started systematizing it and putting it into Excel spreadsheets. And then some of my friends came to me and they said, hey, Kuppy, if you're building this, do you mind flipping it to me? So I started doing that. We called the weekly email Kuppy's event-driven monitor for lack of a better name, I guess. And then we realized spreadsheets aren't as good as a PDF, so we put it on a PDF. And then friends started reaching out to me and saying, "Hey, Kuppy, I've always wondered about this data set. Do you mind, adding it to your list?" And pretty soon we had more data sets than we had manpower for. So now I'm looking to hire 2 guys. It's kind of like snowballed on its own. But anyway, we've created this thing. We're now on volume 15, I believe, of the PDF. But what it does is it tracks all the event-driven strategies I am interested in. My friend, he puts it all together for me, and we're tracking all these different strategies. And you have like some of the kind of like common things which we'd be tracking, like secondary offerings or IPOs or spin-offs, whatever, and those sort of things. You can get them off Bloomberg. There's, probably 1,000 newsletters that track these sort of things too. It's nothing proprietary. It's just good to have a list each week, so you can take a look at the charts and see if anything's setting up right. But then we started adding some of the stuff that really takes manual effort, where the Bloomberg doesn't spit out an answer for you. And that's really where I think the alpha and the edge is going to come from. CEO changes, index deletions, demutualizations, privatizations, exchange listings, busted M&A, like all these sort of things, activist campaigns. Bloomberg isn't tracking this, and which means you're missing it. And partly it's good just to get a weekly reminder of, hey, let's see how that activist campaign's going. But partly it's good because stuff pops up that I would totally have missed otherwise. There's too many ticker symbols. And so anyway, this has been a project of mine where I'm just amazed how much money I'd left on the table over the years, and just how many of these event-driven situations this has been able to flag for me. I'm really excited about it. I've got about 100 friends reading it right now, and it's going to eventually become a little bit of a business because in the end, if we're going to hire a couple analysts to flesh out some more of these data series, it can't be a pro bono sort of thing for my drinking buddies. It's got to have some sort of a revenue stream to pay for all these people. So we're gonna have a subscription. Right now we still have some kinks we want to work out on our side. Especially on just cleaning up the data and making the data, I guess, better. So it's free. Anyone who wants to subscribe is welcome to subscribe. It's kedm.com, KEDM.com. But I hate it when you subscribe to something, then a couple of months later they throw down a paywall, and you're like, I get it.
Yeah.
So I want to be as clear as possible. This thing has to have a paywall, just because I'm not going to be subsidizing everyone else's research process.
Right.
So, but anyway, while it's free, I recommend you go subscribe, and hopefully you'll make some money out of it. And I hope you make enough money that you decide to pay for it afterwards.
Right. And listen, I've been getting it along the way, and it's invaluable.
Yeah, so have I.
It's
awesome.
It's terrific. So KEDM, Kevin Edward David Mary.com. You can go sign up. You can get it for free. Why don't we talk about a few different things that are on here? One of the things that I like best, Kuppy, is the Kuppy's Cliff Notes. Cliff has got a K, which I really like, just like Kuppy's Corner. We're not too smart here. We just use alliteration when you're stuck. And what you do is you go through all the different, let's just say, all the different strategies, and you highlight some of the ones that you like best. Let's just take an example I'm reading from this week's. You have UIHC had a bunch of insider buying after declining dramatically. You note how HYMC also had a bunch of insider buying after declining by more than 20% from the SPAC. And you talk a little bit about your skepticism of Highcraft and who is short Allied Nevada, almost to zero. Anyways, you go through all these things. Why don't we talk a little bit about all the different sections that you have here? Kuppy's Fallen Angels, what are those?
So, just go back to the Cliff Notes. One of the suggestions from my friends is basically saying, hey, this is a big, long document. Can you flag the stuff that you think are like the 10 most interesting, give or take, things to take a look at? Because there's just too much in this world to follow everything. And so that's kind of what we've done with the Cliff Notes, kind of flagging things that are really actionable or that are exciting. When it comes to the Fallen Angels, this is kind of a proprietary screen that we have inside my hedge fund of tracking stocks that are down dramatically over the past 2 years that we think actually are, have a reasonable chance of recovering.
Right.
These are businesses that are reasonable businesses that have come on some hard times, I guess. And, it's kind of like the short list of things that we're tracking here, waiting for some sort of inflection to get long. Usually with some sort of a value backdrop.
Right. So how does that differ from Kuppy's Left for Dead?
Well, Left 4 Dead are companies like Joe where, it's really cheap, but no one's cared for a decade.
Okay.
There's a lot of those sort of things. It's kind of funny. Everyone's like, wow, I can't believe you found Joe, Kuppy. Like, it was more than a double on a multi-billion-dollar company. And I'm like, hey, man, it was on the Left 4 Dead sheet for like 10 issues.
Right. And so then you have three different types of spins: announced spins, completed domestic spins, and international spins. Why don't you tell people what spins are and why you're watching those?
So a lot of what happens that makes money in event-driven is fund flows based. And I think the reason that event-driven's done so well lately is you have all these retail idiots that have no idea what they're doing and they're moving stuff around. And then you have the passive world taking over from the active world. So when something happens like a spinoff, and that's when a corporation takes one of their division and they basically dividend it out to shareholders, you have these ETFs that own the thing that are often forced sellers because the ETF says exactly what it's supposed to own, and it's not supposed to own the spinoff. So you have a situation where the ETF is a seller. You don't really have a lot of active guys watching these situations anymore, and you'll have a situation where you can often buy something that's undervalued short term as the fund flows go in the wrong direction. And we're flagging these because there's a ton of alpha here. The past few years, spinoffs have been less good in terms of interesting situations. But these things go in cycles, and there's a lot of alpha in the first couple of weeks of a spinoff. Just kind of give you an interesting one that last week or 2 weeks ago, there was a company that's AIV got spun off. What is AIV? It's a dysfunctional collection of real estate assets. But it got spun out of a company that was in the S&P 500, and the S&P 500 coughed up the AIV. So when you look at a chart of AIV, you can see this huge volume in the first week that it was spun out. And there were a lot of things you could do. You could write puts. You could play, the volatility spike, the implied volatility. You could have bought it the spin deletion day. It traded about $4.60. I bought some. A couple days later, it was in the low fives. I tossed them. I mean, it's 10%, whatever. But I mean, those 10% add up. And I'm just saying, there's a lot of alpha around these sort of events. I mean, one of the things I want to do with this, with Kedem, I think what that makes it different and special is a lot of newsletters give you stock picks. This is what the guy writing the newsletter thinks is interesting, and we're not trying to do that in any way. What I want to do is flag interesting events where fund flows move an equity around, and I would really hope that two investors can look at the same situation, take opposite views, one guy long, one guy short, and both feel like they got value out of the fact that I flagged the opportunity for them.
Right. I'm going to read you some of the next ones, and you pick which ones you want to talk about. Cluster buys, buybacks, short squeezes, upcoming IPOs, recently completed IPOs, secondaries, upcoming unlocks, CEO changes. Actually, you know what? I'm going to ask you that one. CEO changes. Why don't we talk about that? That's kind of an unusual one that might not traditionally be on anyone's radar.
Well, it's not on anyone's radar, which is why there's alpha. This is one where we're actually basically we have a proprietary way to scrape the data and clean it up and track CEO change. And what's interesting about CEO change is that from a inflection standpoint, you have a new person steps into a situation. It's often because the old guy got fired, or even if the old guy retired, someone new comes in with fresh eyes, fresh ambition, fresh new stock options at today's price. And he's going to do something different with the company, and the company's going to go off in a different direction. And sometimes the direction is better, sometimes it's worse, but it's definitely going in a different direction. The ones I like the most are the ones where the stock is down 70 or 80%. The CEO is terminated. You know that press release you see in the morning, effective immediately, the CEO has left the building, and we take one of our board members who's interim while we do a search for a new CEO. But it's one of those sort of situations where the stock is down, the board's just lost their patience, and then someone new comes in, and I've seen some just dramatic turnarounds because the business itself is just fine. It just had the wrong guy running it. And so, these are sort of things we're trying to flag and keep track of because, you do have a real event there.
Right. Okay, so I'll keep going. Bankruptcies, bankruptcy exits, recent SPAC announcements, completed SPACs, newsletter shorts, new 13Ds, M&A, busted M&A, upcoming stock splits, listing change, strategic alternatives, and these are the last two that I wanted to talk about, privatizations, I can spit that out, and demutualizations. Why don't you tell us about those two and what you're looking for?
Yeah, so let's talk about privatizations because I think this is one of the greatest sources of alpha in the world that people just don't pay attention to. For whatever reason, governments end up owning businesses, which seems like the worst possible idea. Every once in a while, you'll have a new president or prime minister, and he looks at all these businesses that are kind of failing and says, "Why do we own this and have all these employees?" And they decide to privatize it. And when they privatize it, it's often done in a way that the government isn't really focused on getting them the best price, as much as the government is focused on giving handouts to their supporters. So it's often rigged, and I've done dozens of these around the world, but it's often rigged so that local guys can buy it very cheaply. The IPO, let's say they do the IPO at 10, the thing is really worth 30. It opens at 13. All the local guys toss it at 13 to guys like me who then ride it to 30. And everyone in the country is happy about it. And then once it's private, and you actually have a CEO who's focused on the profits as opposed to focused on keeping jobs or hiring political supporters or like the kids of senators, whatever. Usually the operations improve over time, and so you get kind of like a double dip where the thing was priced too cheaply to begin with, but then over the next year or two, the business starts doing better than expectations. And I've had just some multi-baggers in this world. We flagged last week Icelandic, which is the Iceland bank. I mean, there's 3 banks in Iceland. It's kind of a monopoly sort of business. You have excess net interest margin. They actually have a yield curve still in Iceland, which is very different from pretty much everywhere else. This thing had been nationalized when Iceland. Basically, I guess before the global crisis in 2008, Iceland was more or less a giant hedge fund that also did some fishing. And so anyway, when it turned out that the banks had was it like 20 times their equity in a bunch of like insolvent assets, they all got nationalized and Iceland went bankrupt. And 10 years later, they're now privatizing it. And It's kind of a quirky sort of thing where it's going to be privatized. You have to be Icelandic. You have to open an account there. But then I'm sure this thing will get listed on like the LSE or something a year later, and it'll get added to the MSCI because it's the biggest asset in Iceland, and it's probably just a multi-bagger. But these are sort of things we're flagging, and doesn't mean you have to actually, go do the legwork and do all of them. I would actually think you probably do very few of these trades, but we just want to flag what's happening in the world and let people figure it out on their own.
Right. And finally, demutualizations. What are those?
So this is kind of like a legacy of America more than other countries, but a lot of banks were thrifts or mutual associations, a lot of insurers as well. I caught just a monster. There was a company called, it was still called Calavo Growers. It's an avocado cooperative. For whatever reason, for 75 years, and they basically had a cooperative that bought avocados and marketed them. And for whatever reason, they decided to demutualize about 10 years ago. And anyone who was part of the cooperative got shares. And so you have this funny thing where you have an avocado grower who suddenly gets shares. He says, I don't really want shares. I want fertilizer or more land or, a new boat or something. And they just dump the stock. And, I was buying this cooperative, at $5. A couple of years later, it was at 50. You just get these sort of situations. There was a demutualization in Australia last year of the Rice Growers Association. You have these quirky, weird things where, people end up with shares that have no interest in owning shares. There's no IPO. There's no underwriter. There's no brokers behind it. There's no one pushing it. There's probably no investor relations function even. And so the shares just, flail around for a year or two, and then eventually they get quote unquote discovered, and they're amazing investments. So it's another place full of alpha.
Okay. Well, so let's just repeat one last time. Go to kedm.com. You can sign up. It's going to be free for a while. Eventually he will charge, but in the meantime, you can get it free. It's probably, you at least got a month or two, I would assume, right?
At least.
Yeah, as he irons out the quirks. And so if you have any interest in these kinds of trades, make sure you check it out. It's something that I put, it comes out at Sunday afternoon. What time does it come?
It comes usually Saturday morning, unless I'm
Saturday
in Costa Rica traveling, in which case it comes Sunday.
Yeah. So
but it's free. You get what you pay for, right?
That's right. So it's always weekend reading. It's really interesting. And Kuppy, thank you so much for being on the show for this past year. We really appreciate it. We enjoy all your calls, your unique insights. You're a true gem, and we look forward to another year with you at Kuppy's Corner.
Hey, really appreciate having me on, guys, and thanks for doing the infomercial.
Thanks, Kuppy.
All right, take care.
Patrick, I know everyone's been dying for this time, just like me. I've gone a couple of weeks now without talking charts. I'm curious what you're thinking.
All right. Well, before we get to the actual charts of everything, let's talk about the top 3 things we were watching before we got to our holiday specials. And so the first thing we asked was, does Santa Claus come to town with the Santa Claus rally? And well, it was a little bit choppy, but generally the market was rising throughout that entire period, right?
I think that Santa Claus came. It looked good.
Santa Claus came. No, Santa Claus came. It wasn't like a parabolic Santa Claus rally, but generally the trend was higher, and so yes. And
I would say the only thing about it is traditionally that rally has continued to the first day in January, and I believe that the first day in January this year was not as good. Let me just have a look. Yeah, that was the first down day. So if anything, that was really, Santa Claus was a little hungover from the New Year's celebration.
All right. Well, the number 2 was is this a breakout in precious metals? And it was interesting that we talked about that because we were talking about this all the way back over here in the latter part of December. And we right into the early part of January, we got this big breakout, and suddenly, and just in the last 3 days, the entire breakout reversed quite violently. And so it's sort of a wishy-washy outcome at this moment. What's your take on this break?
It looks to me like that noble animal pattern.
Yeah, the prairie dog.
It's a prairie dog. No doubt about it. The gold prairie dogged it. It's looking terrible. It was an ugly day today, Friday. What were we down? $70?
$78.
Yeah.
It's the ugliest day since that November 9th drop when the vaccine news came out. So this takes all the wind out of the sails of gold, and so it'll be interesting to see what happens and falls. We'll talk more about that in when we get a little more deeper into the charts. But the number one thing we were watching was does the dollar bottom out in the 2020 calendar year? And the answer is no.
Yeah, of course, because that was you always looking for your dollar bottom.
Well, we were just no. It was very oversold, but I mean, no. Look, we have some reversal candles coming off there, but it didn't stop. Like, I mean, the first few days of January really just continued to break down lower. We're down at the 89 handle. The big move, obviously, was even again in the renminbi. Just some of the different currencies are. The U.S. dollar continues to be distributed. I think that we are way overdue for a counter-trend rally that is nothing about a major trend reversal in the big picture, but it's so consensus that the dollar short is the easy trade that you have to think that there's going to be at least some event that kind of checks everyone's willingness to stay with it with some sort of a squeeze. You don't think that that's still on the table?
It'll happen when it's no longer in our top three for sure.
When it's not in our top three, I agree. All right, so let's talk about the top three things to watch for next week. And so let's go through, and obviously the first thing we have to talk about is Bitcoin, because this is just absolutely gone parabolic.
Yeah,
and just up every single day, and you know what? I always look at these moves in a perspective like this. Like when you got a parabolic rise, it's very challenging to even try to speculate what price level the high will come in at. I mean, it could easily be 50,000 or 60,000 or even higher, but what I do know from at least experience is that when we get to this parabolic phase, it means that it's some sort of a short-term to intermediate top is likely to happen in a very reasonable window, probably even in the month of January. But it could still be at much higher prices, so I don't want to already be bearish it. But this parabolic rise is just like the froth getting really thick here. And so I don't know. What's your feeling on it?
Well, I'm having fun staying poor, and for those who don't know,
you got hammered on that tweet.
For those who don't know, if you get on Twitter and you talk about Bitcoin being anything but the next coming of Jesus, you get told have fun staying poor. So I'm having fun staying poor. It looks like a cult to me, but so be it. It's going up. Listen, you guys nailed it. Good for you guys. You absolutely nailed it. But I do think it is getting frothy. And just as an aside, I started off a little bit of a stock market game with my son. On Market Watch, you can go and put it. You both get $1 million account. We started on Monday. Patrick, guess what he's at already? He's at 1.35 million. I'm sitting there down a little. And he's got
it figured out.
He's got it figured out, man. He's telling me like he's buying all the Bitcoin companies. He's got it all figured out. So I would just I'd be scared if I was people, but so far I've been scared the whole way, and I'm poor because of it. Number two, what do we got?
So does the New Year money run out this week?
Yeah. So we've got a huge push into the stock market with all the stimmy checks, as the kids call it, right? Did you know that? The stimmies? That's what they call it. Yeah, the stimmies. Patrick, you don't know anything. I'm a little
No, I'm not in the lingo.
Yeah, you're not in the lingo. And so they took their $600 stimmy check and they put it all in Bitcoin or out of the money Tesla calls when they YOLO'd those into all this money. But it's rushing into the markets. It's causing a real froth. And the question is, does it run out? Or is this just the start of a bigger move? I don't know. That's what we're watching.
Well, you know what? For me, I continue to think that every rally always is checked, and so it's. I don't want to try to call that there's a imminent major top any day now, but the market is very robust. It's been rallying quite a bit, and particularly the bubble stocks that have been running have already gotten into these real parabolic phases. It really feels like some sort of a swing high is going to come soon, but maybe the S&P 500 crawls all the way to 3,900 to 4,000 before that happens. I don't see much asymmetry in pressing without having an exit strategy on your trades. But I mean, as long as you have a shorter time horizon and you have an exit strategy, I guess you can keep riding the momentum of the prevailing trend that is quite dominant, right?
That's for sure. What do we got for number one?
Well, we got to talk the 10-year yield, right? Like that 1% level on the 10-year yield was such a key overhead resistance for so long, and suddenly we've broken it, right? And so with this breakout, we've already hit about 112 on the upside, but really just the last 2-3 days have just been a legit full-on breakout. And the big question now is this the breakdown in bonds that Kevin Muir has been looking for?
Well, before you start giving me too much of a hard time about that, Patrick, where's the yield curve control that everyone was screaming about that was coming?
Well, you know what I mean. Yeah, it could come at higher levels. Yeah, you're probably right on that one. But
there's been more pushback but when I said that than when Barack Obama wore a tan suit after Labor Day. Like it's like. I got so much flack for saying no, there's no yield curve control, it won't happen. I still contend it's not going to happen until 2. Like everyone's freaking out about these bonds. Step back. Can you do that? Can you make that chart a 10-year chart for me?
Yeah. Oh, like here, let's go even a monthly chart.
Well, no, let's step back and really think about this. If you go back and look at like 10 years, and we think about it.
The yields for a considerable amount of time stuck just in even this 1.5% to 2.5% range, right?
Yeah. Well, Patrick, guess what it was at the end of 2018? The 10-year was 3.25%. It was
at 3%. Yeah.
So everyone's freaking out because the bond has gone from 50 basis points to 112. This is nothing. This is honestly, this is nothing. This hasn't even started.
Wow, it's entirely possible, right? Like it's and I mean, because the Fed's got the front of the curve pinned, I mean, this is going to be a full-on bear steepener, right? Like this is. Are you playing this predominantly with like a 2.10s or 5.30s?
I have them both. I have them both, and I have lots of long. I have puts on the long end, and you know me, I'm like a big, huge fixed income
bond
bear.
So
yeah.
Yeah, but I
got to do something. The fact because I'm busy staying poor because I don't own any Tesla, so I need to have some trades working. Or not Tesla, Bitcoin. Although that's another one. That's
well, actually, I want to talk about it. Anyway, that was our top 3. So let's actually just talk about some of the other interesting charts. What I wanted to just highlight, which was I continue to think is so interesting, is this Russell over the Nasdaq, which is sort of showing that rotation. And that Russell was a huge underperformer for years and years, and the Nasdaq was clearly that we're taking all the money flow, and we've now seen a substantial basing formation establish itself, and it looks like a chart that's like a breakout in yields. Right, like it looks like the base and breakout in the 10-year yield when you look at this, right?
Yeah, it is a very similar chart.
Sorry,
it is a very similar chart.
Yeah, and so the biggest question, and you know what's interesting is that a lot of new money rotation is finding global developed markets. Like I mean, when you look at some of the like the Euro stock continues to do very well in this kind of post November 9th period when the vaccines started coming. But look at the rip that we got overnight or yesterday on the Nikkei. Or earlier today. Like, I mean, the Nikkei is just breaking out with a huge velocity. But even take the South Korean Kospi. Like, this thing has gone Bitcoin parabolic. Like, it's maybe not, but it's just pretty significant where you're seeing. And so, and even like China, like this is the China A50. just their stock market. So the thing is interesting is that not only is the Russell doing well relative to the NASDAQ, but we're seeing a lot of global equity doing very well. So we were in that period where being long U.S. equity was the trade, right? And it seems now that you have so many places to go around the world where you're getting some incredible performance relative to the S&P even.
Well, yeah, those are great charts. I don't think a lot of people are talking about them. Everyone's busy staring at the U.S., and meanwhile, other markets are flying.
Yeah, no, it's for sure. And what's also interesting, I wanted to just touch on oil, which just doesn't want to quit. Right, obviously Saudi Arabia kind of gave this a little bit of a boost, but with this breakout, I mean, are we going back to the pre-COVID highs and back to 56, 58? It certainly feels like it. It's got some really nice momentum. But what's interesting is it's really being confirmed by this breakout in gasoline. I mean, gasoline futures were kind of stuck in a trade range for much of the second half of 2020. And really, this kind of last couple of weeks have just really seen this start to accelerate and break out of that range. And so we're seeing that in gasoline. Obviously, nat gas has been relatively weak, but copper breaking to once again a higher high. So many of these commodities, but even like the eggs, did you? I guess you are watching the soybean and corn charts, but like unbelievable rises right across the board on all those. That's the beans. You got corn just ripping. You've got the commodity markets outside of gold are pretty robust and frothy. It's like bull markets everywhere, right?
It's not almost like there's inflation out there, Patrick.
It's well, I mean, obviously that's what's driving a lot of the 30-year break-evens breaking out. Like, I mean, inflation expectations rising. How does the 10-year not go up in this environment, right? Like it's.
Oh God, don't say stuff like that. You're gonna gooch my trade.
Hey, I'm not in, so you're safe. Once I get in, then you should be worried, all right? Anyway, I think that's enough. We have a full show. I think that's what I wanted to cover. But it's lots of really interesting things to watch. Actually, no, wait, one more thing we have to cover. Tesla. Holy cow. Yeah. Like this thing has gone full. Like it's at $900, at $880.
It's unbelievable, isn't it?
No, but what is nuts is that right now Tesla has you take General Motors and you merge it with Ford, and Tesla is now almost 10 times the market cap.
Yeah. Well, what I find even more amazing is that he is the world's richest man.
Yeah.
This is the guy, if you go and look at his tweets, like my 16-year-old has more sense than this guy. Seriously, like you see the shit he tweets, like it's just like unbelievable. It's not even Huddle worthy. Like I can't say stuff that he does on the Huddle.
Well,
anyway,
when you're the world's richest man, you can say whatever the fuck you want. I guess you can do whatever you want.
Not only that, when you're endowed like him, you have a bad back. Okay.
All right, let's move on.
Okay, Patrick, time for This Week in Trading History. What do you have planned for us?
Oh, it's just a super quick hit. What was really, it was back on January 1st of 1974 when the Arab Gulf nations doubled the price of their oil overnight. So it kind of started a little earlier. The oil embargo was announced on October 6th earlier then. Oil prices in the U.S. quadrupled in just the following 4 months after that. Originally, the price increases from the Arab subset of OPEC came as a result of the United States' support of Israel during the Yom Kippur War of 1973. And the price increases pushed the U.S. into a deep recession, and it became a key precipitating factor to inflation, which spiked during that period. So in 1974, both unemployment and inflation would be around 9%. the highest the United States had seen in decades. And besides the drop in the stock market and the rise in oil, the period would usher in several long-term changes, but notably, with sticking with the oil theme, it would lead to the considerable rise of power of OPEC. This period in 1973 and 74 proved to the Arab nations that the strength that they held over the rest of the world with their oil reserves. And for several decades, Arab nations such as Saudi Arabia, Iran, Iraq, Qatar, and the United Arab Emirates would find themselves flooded with cash as the value of their oil reserves grew substantially. So it was that period of inflation, and a lot of people have forgotten it, haven't they, Kev?
I haven't, Patrick, although I wasn't around. I was around for it.
You were just
I was watching $6 Million Man on TV, but otherwise I was there. Even you were there.
I was born after this. I was born in 74. Well, anyway, but
actually, I wasn't watching $6 Million Man yet because that's only 4 years old. But anyways, who knows what I was watching? Sesame.
There you go. Anyway, that is our history for the week. So let's go on. All right, time for No Stupid Questions. Lena, hop on.
Hello.
Hello.
Hey. So it's getting closer to the end of the show here, but let's punch through a couple of these questions. So what do we have here?
So the first question of the new year. Good job with Jack Schwager interview, lads. Very cool. I'm still a noob, so I hadn't read any of his books. I've just completed the Market Wizards audiobook marathon. So thank you for introducing me to that. My fiance probably thinks you a little less. Firstly, how come neither of you two are in these books? Secondly,
we're odd lotters.
Secondly, a common theme amongst the traders was keeping a trading journal. As a result, I went out and bought a nice new 2021 hardcover diary. I opened it today and realized I don't know what the fuck I should be writing in it. Do you keep a trading journal? If so, what do you write in it? How do you structure it?
That's, great question. I was just chatting with Patrick the other day, and I told him that my father brought by a book for me. And it was my trading journal from 1991. I was 21 years old, and it was the start of my kind of chronicling what I thought of the markets and what I was experiencing. And the funniest thing was that it wasn't as bad and as cringeworthy as I was expecting. I was expecting it to be terrible.
I actually did that as well, and I dug up an old one, and it was as well. I was doing a lot of S&P day trading at the time, so I was kind of journaling a lot of the day trades I was doing, and I thought it would be a lot worse, and it was. But it's so much how we learn over the years, right?
Yeah, but the funny part about it was, I jotted down kind of what the market had done and put down the moves. And the funny thing was to say, like I read, the S&P had a huge day. It was up 10 handles. That was a huge day. Yeah. It was up 10 handles. Okay, so let's get to it.
What I was just going to mention that at Big Picture Trading, in our Trading Masters program, we have a whole segment on writing trading journals. So you can always check that out and see if that would be able to help you out. Shameless plug anyway, but let's get to this.
Just a quick, actually, before we do, we'll just go, Patrick, one quick second. In terms of the trading journal, what you should put, we'll just keep it nice and brief. No. There's two things. You should write down all your trades, and then you should write down how you're feeling about them. And that's in essence what you should be doing. And too many people think that trading is all about figuring out the optimal moving average or this trading system, where they don't realize that actually what you are battling is not just the market but yourself. And as you get older and as you trade more, you'll realize that second part, battling yourself, that is going to be the part that holds you back. And so the trading journal is designed to help you try to realize where you're kind of forcing it about, where you're making mistakes. So one of the things to write down is your emotions, what you're thinking, and trying to figure out ways to help yourself through those periods.
Yeah. All right, Lena, hit us with the next one.
The second question here is, this is a question for Patrick about the dark art of options trading. I'm a member of your Big Picture Trading website. It's a great way to learn about options trading. You divide your option strategies into 4 broad categories: breakout trades, hedged positions, long-term options, and options for income. Over your 20 years of trading, which of these categories have been the most important driver of your portfolio returns, whether generating upside or protecting against the downside? By the way, love the Dennis Gartman interview. Great stuff, Kevin.
Oh, it gives you the plug right at the end. Anyway. Well, you know what? The interesting part is that if going through my entire career, the vast majority has been option writing, because that's where I cut my teeth when my CIBC days, when I was trading with a portfolio manager and managing it. And so my early years was all about theta harvesting and premium harvesting the markets, and that has been probably the single most consistent way I've made money over throughout my entire career. Like a lot of the other services that I provide have been things that I've kind of honed in over the last 5-10 years. But income harvesting is by far the most consistent one, and the one that has done right by me the best over the long term. That's all I'm going to say about that. How about you, Kev? You're always a theta harvester, right?
Well, yeah, I'm kind of changing my tunes a little, but you're not giving yourself enough credit. I've seen your trading. I've seen how you've done it. And the fact is that you went through March, and if you were truly short all sorts of options, you would have been down a lot more than you were. In fact, you were anyways. Folks,
Yeah.
I probably shouldn't say things up, but the reality is that he did much better than most people through March, and the reason was he was long options. There's lots of parts of his strategy are actually long gamma, and you know what? He's teaching me the benefits of being long gamma.
I'm converting you, eh? Why do you know?
Me.
All right.
You better figure out how to sell more then.
All right, Lena, tell them where they can submit their questions if they want to find us.
If you have any questions for Kevin and Patrick, submit your questions to nostupidquestions@markethuddle.com.
All right. So, Kev.
Oh, God. Time for skin in the game. And I've lost again, right?
Listen, sometimes just these streaks. Like, I felt like an idiot losing 3 in a row right off the bat when we started this. It's like sometimes you just go through. It's these drawdown sequences where you go through.
I think you figured out how to get my number. You dangle my weaknesses in front of me, and you play for them very wisely. I must say.
Well,
very
I mean,
wisely.
we have to be a little bit tactical about
I
this.
think that was a problem. You weren't tactical, enough at the beginning, and now you figured it out, and you've kind of. I got to stop telling you what I think about things because you use it against me. Anyways, well done, buddy.
All right.
Well done. You deserve kudos.
So let's first go through the bet. So when we did our last show, it was a very simple bet as to whether or not on the week Christmas Eve on December 24th, whether Tesla would close above or below 650. And at the time, it was trading slightly higher than that. And the bear in you was itching, and you said below.
Yeah, I don't think straight with Elon. I don't. And I said it. And you know what the thing is, though, Patrick? I almost won. Going into Thursday in the morning, I woke up. I was on side, and then they had this stupid Santa Claus rally. You rightfully realize that, and they ramped it up. In the last day. I feel like
You know what? I feel really generous, and I'm going to do. Something that is going to make you cringe a little bit, but I think you will know which side to take. But when I had to kind of choose a level on this bet that would be, that would be something that would make you think about it. So let's see if I did it or not.
So before you do this, let me explain.
Let's talk about the rules.
The game.
Yeah.
The Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to be settled by the next episode, and the currency for the wagers is as follows: a Duke and Duke, which is $1 crisp American dollar bill. Pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4 here in Canada, bottle of wine with a $100 limit, and finally the big Katuzi, the steak dinner, which we still have not done yet. We have not done. Anyways, the winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and this is like before before the great financial crisis. There will be no netting of positions. All swaps must be settled in full with the counterparty.
Settled in full. When the pitcher of beer is the hardest one to deliver, we're just going to have to call a whole bunch of our listeners.
We are.
Out
We're going
to
to
the
have
bar
a
one time.
huge piss up.
Yeah, because otherwise, all the wine and beer, I'm just gonna rent a U-Haul van and come over and collect.
We're doing it. The moment that we go, the COVID goes, we're allowed to. We're going to do it.
There you go. All right, so it's time for me to present this week's bet because you lost.
Yep.
And you get to pick. Ready?
Yep.
I'm going to go for Bitcoin.
Oh, God. You bugger.
One touch, 50,000 over the next week.
Oh, sold. I won't take that. It's not hitting that. Well done. Good bet. I'm probably going to lose, but I think we're close to the top.
So you're saying it won't touch?
No.
I went too high. Damn it! I should have gone a little lower. I was trying to pick something that would. All right. Anyway.
Oh, you wanted the downside too. You wanted the no.
Well, I don't know. Like I was trying to. Well, we'll see. Let's see what happens.
If you gone any lower, I would have taken it.
Probably.
Like if you gone 45, it's a no-brainer. So 45.
I had to put the right hand. I had to put the right handicap on this, right? Like it's anyway. So all right. So what do you want to start at the betting?
Let's just do a pitcher. Let's get the pitchers adding up for our big piss up.
No, let's take it down to burger bet. Come on, let's just. I'm hungry.
Okay, burger bet it is then.
All right.
Okay.
All right. Burger bet 50,000, one touch.
Yeah.
It doesn't matter when it happens, but it's whether it did it or not by Friday's show next week.
By the way, the fellow who gave us our beers, my good pal Andy, he's actually a huge he doesn't like Bitcoin bull is not the right word. He believes there's a huge demand out there, and he thinks it's headed a lot higher. He has been steadfastly picking us all off with his bets, and I've been waiting because I got tagged, before. And I'm offside a steak dinner with him already. And yesterday when it started to look weak, I decided to double up. And I did a bet, and it was basically 30% up or down, and it was like one of us is going to win. So if it touches 30% up, then he wins, and if it touches 30% down, I win. And our number is 51,000. So not only might I lose this bet, but I could also be losing my steak dinner bet at the same time.
Oh, there you go.
Anyways. Okay.
Such is the world of being a gambler.
Yes, that's true. Well, being a Bitcoin bear. Well, do you know what? I have to make good on my have fun staying poor. If I don't lose anything, then I'm not going to be poor.
No, that's huge.
Yeah. Thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow at the Market Huddle. We're there on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and I. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. I've learned actually, Patrick, by the way, that you're supposed to say, smash the like button. So smash the like button. I was watching some other thing. I was cheating and watching somebody else. Anyways, please, if you could, rate us and review us on iTunes. I'd appreciate it. And Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you could find me at bigpicturetrading.com. How about Kev? Where can they find you?
So I'm on Twitter at Kevin Muir, or you can check out my my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Oh, that's a good show.
So, Lena.
Yes.
Hello.
Hello.
We have to tell everyone about Patrick, first of all.
Well, let's talk about this beeping noise that's in the background.
Yes.
I don't know if anybody can hear it.
Yeah. So for those who don't know, Lena is, well, first of all, she's a woman, and so that's very clear. And so she notices tiny little things that makes sounds and stuff like that. The only other time that a man might notice this is if something in his car was rattling. But otherwise, men are pretty oblivious. And during the Cem interview, Lena was saying, "Where's the beeping coming from?"
Yeah.
And it ended up being Patrick. Patrick, why don't you tell us what the beeping was?
Well, Well, I'm down here in Barbados. I set up a winter headquarters for
The big picture
for
trading headquarters.
winter headquarters.
You're like Ken Griffin from Citadel when he's got his Miami headquarters. But you're going Barbados. You're going full Caribbean.
Yeah, I went straight to the islands. Yeah, and this place is littered with these like tree frogs that basically are so loud. And like Lena is picking it, and my windows are all closed. There's absolutely no way that I could make it any more soundproof. And they're so loud outside that Lena's picking it up on the microphone. It's like,
But Kevin,
what
you
the
said you
hell?
couldn't hear it.
I couldn't hear.
Yeah.
I don't know. I don't hear anything.
So unfortunately for the next 3 months, I'm not going to be partaking in you guys sampling our featured beers, and I'm going to be drinking this Banks Caribbean Lager basically the whole time I'm down here.
Yeah, well, we really feel for you.
Yeah,
Patrick
in
sent
your
me some
30-degree
pictures, and I
weather,
was like,
please.
that bugger. So, Lena, let's rate this beer.
Yeah, let's read this
I
beer.
love Andy. I appreciate all of his time, all the things he does. But I do not like this beer. I don't know. Sam, I just don't like it. I'm giving it a 6, which I know is a rookie score because it's even. But that's what I'm going. That's where I'm going.
Oh, okay. You disliked it more than I did, I think.
Yeah.
I
Oh, you liked
didn't
it?
mind it at all, actually. It was
Oh,
a little
nice. Well,
hoppy
there
for
you
me,
go.
but it wouldn't be my first choice, but it's not something that I would dismiss either. I would give it a 7.3.
Oh, you're very nice. You're just always so nice.
I
But
just
Andy
like
was
beers.
kind enough. He gave me a whole bunch of other ones, so we're going to work through the other ones. Maybe I'll find one that I like. And if worst comes to worst, I'm going to drink his wine that he also gave me.
Oh, I
He's
didn't get
very
that.
kind. He actually gave us. He's a big fan of the show, and he's actually done this before. He was all of our Niagara beers that he gave us for sampling back then. He was the one, and so I definitely found ones that I liked in there. But my son built him a new computer, so he was paying us back with that, even though he did also pay my son. Anyways, he's
Thank
too
you
kind.
for the beers.
Yes, thank you very much. So, what are we going to talk about?
How did you guys have a good holidays?
Well, I don't know, Lena. Did you have a really good holiday?
I had a pretty good holiday.
Anything happen?
What-
Lena?
anything really interesting happen?
I got a rock.
A rock? Like
Wow.
like you got like your kitchen. You got a new countertop.
No, I got engaged.
Oh, awesome! Congrats. I'm sure all the listeners are really upset that.
Hey,
Damn, I thought she was single.
for all you know, I could be like, overweight and living in my mom's basement. So you have no idea what I
No,
look
that's
like.
me. That's me, Lena. That's not you.
But yes, I've said,
Anyways, congratulations. I actually saw, Lena shared it with us, and Luke did a terrific job, and we wish you all the best, and I know you two will be very happy together. When are you going to have the wedding? Are you waiting for the COVID?
Oh, yeah, we can't really plan anything until, our COVID restrictions are lifted. And God knows when that's going to be, so we'll see.
We'll see.
We will see.
So he has an excuse to keep kicking the can down the
That's
road.
right. It's going to be forever.
Yeah, or we would just go down to City Hall and sign some papers. To
Well,
be
do you know,
honest,
Lena,
that's
that-
kind of what I want. I don't even want a wedding.
So, Lena, do you know what my wife and I did? We were getting married, and we were planning it all out, and we were doing all this work. We're going and looking at different venues.
God, yeah.
And we looked at each other, and I was like, dude, like this doesn't seem like very much fun. And she's like, no, I don't want it. And I was like, I don't want it. Why are we doing this? And she's
Yeah.
like, okay, well. And so we took the money we were going to spend on the wedding, and we blew it on a cruise.
Awesome.
And we went on like this little 100 boat cruise in the Caribbean, and we got married on the boat in St. Thomas.
Oh, wow. I didn't
Yeah,
know
and
that.
Xavier, the bartender, was my best man and our witness. And literally, that was it.
So you didn't have any family come
Nobody.
down?
We just basically
Wow.
eloped. And you know what? The most amazing part of this story, we did not have a kid for another couple of years.
Oh.
Wow. I was about to ask if your kids attended the wedding.
No, just kidding. Because everyone figures, oh, she was pregnant. That's why you did.
Like
No.
shotgun wedding?
The shotgun wedding. No. Anyways, yeah. So we did that. It was great. It was
I just
terrific.
don't really see a point of spending, weddings are expensive
Oh,
nowadays.
yeah.
Like, they're like, I think a friend of mine spent like 30, 40 grand on a wedding. and she was stressed out throughout
That's
the whole
it?
thing.
Yeah.
Like that's a cheap wedding.
Well,
I
even
think
then, right? Like, to me, it's like, okay, it's supposed to be one of the best days of my life, and I'm going to stress out and be broke by the end of it? No thanks.
Exactly.
Yeah.
So just do what we did. Spend it all. Spend the 30-40 on a cruise.
That's kind of what we're thinking.
You
Maybe
can
not a
get a
cruise,
nice
since,
cruise for
you know,
30
this
or
whole
40
COVID
grand, you know.
situation, but you know, something else that's not like renting a banquet hall or something.
Yeah.
So, but
We said we were going to have a party when we got back. We never did. No, honestly, we did. And we were like, oh, we'll have a party when we get back. And nothing. No. Anyways, that's good. So, Patrick, how are you enjoying Barbados?
Oh, I'm still in goddamn lockdown over
sunny
here.
prison.
Okay, so tell us the story. What happened?
Oh, well, no, it's just the thing is that there's still a backlog on the test. So when you land here, you don't have like a 14-day quarantine like we have in Canada, but you need to have the results of the second COVID test when you land over here cleared so that you can go and roam the island. And it's all backlogged, and we've been basically here locked in this horrible villa, right? Yeah. but yeah, still waiting for the results.
Okay, so we gotta set the picture here. First of all, Patrick says we. It's him and his entourage crew.
yeah.
He's like Vince. What's Vince's last name
Oh, I
in
don't
entourage?
remember. I can't remember.
Yeah. And he's got Ari and all the other guys that were down there with him. There's literally
pretty cool
crew
crew.
of them. And the best part of this story is, so what happened was he got there, and you have to stay in a government-sponsored lockdown, or if you're willing to, you can hire a private guard
security. Yeah.
to stand outside your house to make sure you never leave. So Patrick
Yep.
says, yeah, for sure. Me and the boys, we want to do that. And then there's this huge outbreak there, which is not because
And
of
it's,
Patrick.
it's a backlogged.
Yeah, there's
It's not because of me.
and so there's this huge thing.
It's costing me $600 a US a day.
$600 a night.
Fucking day to be locked down.
And I'm just like, this is the greatest scam the Barbados people ever came up with. Yeah, like you got to do this guard, and don't worry about it. It'll be fixed in one day. 8 days later, Patrick is... It's like, oh
that's
God,
funny.
you
I
should have
call it
figured
the
out what
sunny
you...
prison.
Yeah, but anyways,
yeah.
it's pretty nice though.
It is
But you guys
nice.
must be going a little stir crazy.
Oh no, there's plenty of rum to keep us in check.
I can just imagine I've been with that crew, and they definitely are drinkers. It's they
Hope they don't
definitely
run
like
out of booze. That would be tragic.
Oh no, we've had so many deliveries already. That's the one thing that's being constantly delivered to the villa.
You can just see
As
them.
long as the alcohol is stocked, it's all
The
good.
stupid Canadians need more beer and rum. Send it over.
Yeah, that's
Oh well.
it, man.
Anyways, do you have TV, Patrick, or did you watch anything?
No.
Okay, I got one for you. Did I tell you about the flight attendant?
No.
Oh, Lena, you're gonna like it.
What? It's called The Flight Attendant?
Yeah, on HBO.
Okay.
It's the woman. I didn't realize this because I don't watch this show, but The Big Bang Theory. It's the woman from The Big Bang Theory.
Which woman? There's two.
I don't know. The
The blonde one?
Yeah.
Like the quote-unquote
Yeah.
pretty one?
I don't know. Anyways, it's one of the ones there. Google it while we're talking, and I loved it. Big fan. Actually, I should see how many tomatoes there are.
What was it called?
The Flight Attendant. Let me see how many tomatoes. Let's see if my theory works because I liked it a lot. Oh my God, this is a bad call. 68 tomatoes is wrong. You know what? Something's happening to the markets these days. A lot of prices are wrong, and this is another example.
Everything is mispriced.
Yeah, everything's
It's,
mispriced. This is too. That's too low. That should be higher.
What kind of movie is this?
It's not. It's a series.
Oh, it's a series. Okay.
Yeah. Anyways, I liked it. It's
I have
kind of
mixed
campy.
feelings about this actress, so I don't know. Maybe I'll check it out.
I don't know. I didn't know her at all. So to me, she was just some new actress I'd never seen before. I liked it. It was campy. It's kind of Ocean's 11-ish.
Oh, okay. Then
Yeah, like
okay.
in James Bond in terms of like all the way they do multiple screenshots and stuff, which it can be annoying. Like I kind of get it, but I loved it. I thought it was great. My wife didn't like it as much as I did, but I really liked it.
If
I thought it
it's
was really
anything
good.
like James Bond, I will love it.
Yeah, well, anyways, I'm just saying the way the cinematography and this, they make the multiple
yeah.
boxes and stuff.
Yeah.
And then the other one, Lena, are you watching? Is it Bridgerton? Is that what it's called?
Oh, I haven't seen it yet. I'm saving that for after next week because my dog is having puppies.
Your dog is having puppies.
Yeah.
Oh,
Yeah, see, that's why she got The Rock, because her dog was pregnant.
that's right. Okay, well, don't know what TV has to do with your dog having puppies, but anyway, so be it. Bridgerton actually gets 86 tomatoes. They got this wrong. I'd flip them, but Bridgerton's pretty solid. It's Gossip Girl meets Downton Abbey.
Oh, perfect. Yeah, I gotta binge watch that. That's why I'm saying I can't watch it until
It's
the
pretty
puppies
good.
are
Actually,
born.
my daughter crushed that. Oh, she watched that. I refuse to watch that kind of shit. But
You just refuse to watch any TV. Period. No pop culture.
no, none at all.
How about you, Lena? Did you watch anything good over the holiday?
You know what? I actually didn't watch much because I was looking at my ring.
Oh, I was staring in my ring for a week and a half. Nice. Okay, well, let's tell me a little bit about your dog having babies.
So
Did your dog get out and
No. It was
German
all
Shepherd
planned
next
out.
door knocked her up?
It was all planned out. We have a toy / miniature poodle, and we were thinking after this whole COVID lockdown, I was like, maybe we'll get another dog. We'll get a second dog, and then we decided to look
You can
for
just
another
buy a
dog.
second dog. You don't need to you don't need to get the dog pregnant to have a second.
No,
one.
I understand. But when we were looking for another dog, even our, regular breeder, when we went to look for them, they're not really available anymore. I don't know if that has anything to do with COVID, but
I think it does. There's no dogs. Like if you go look at the pound is empty of dogs.
Yeah, and then plus when we did find some, they were like $4,000 or $5,000.
Oh my God, for a dog?
Yeah. I could not believe it. So I was like, this is not happening. And our friends have a mini schnauzer and they're best friends. And they wanted a second dog, but they also couldn't find another second dog. So we said, well, why don't we just make puppies?
So you're having a mini schnauzer, mini poodle half breed?
Schnoodles, they're
A
called.
schnoodle.
Yeah.
I love it. A schnoodle.
We're having
I got a mini schnoodle.
Yeah, we're getting mini schnoodles. She's
God.
pregnant with
That's awesome.
four puppies. So she's due next weekend.
Nice.
Yeah.
I have kind of a weird question.
Yeah.
First of all, how did you know the dog was in heat?
Wow, she's had her heat before, so I kind of
you know what it looks like.
Yeah, I knew
or
what
you
it
could
looked
smell
like.
it. And so, did you just turn off? Did you put on some Barry White and turn off the lights and just leave them? What did you do? How does this work?
Oh, they just know. You just let nature do its own thing, and it runs its course. They know
is
what
it just
needs
a
to get
wild
done.
weekend? Is it a whole weekend they're together? And
it's like we ended up getting together, and then 5 minutes into getting together, they're already at it. So they know what needs to get done.
So did you videotape it and put on National Geographic?
No.
you know what? You always take things too far, man. You always take them too far.
Although I had, seeing it happen in real life, like in person, I've never seen dogs mate before. Like I've seen dogs humping each other before and stuff like that, but never actually really mating or breeding.
Yeah.
It was something else. I was very surprised. I was not ready for what was happening.
Okay,
Let's
so
just put it
Lena,
that way.
sorry.
I'm not gonna
You
get
can't
into
just
the
say
details.
that.
And you
can't
didn't
just say that
videotape
I
it.
wasn't
No.
See,
ready
what
and then leave it at that. That's not good enough. I'm
No,
sorry.
You gotta Google it or YouTube it or something because I cannot explain it.
Really?
It was something that I didn't expect. Yeah, it was interesting.
Did your dad or your mom not talk to you about the facts of life?
The birds and the bees and the dogs.
I'm sorry you had to figure it all out that way, Lena.
No,
I'm really sorry.
It's when they were done. That's kind of like oh, and then something happened, and I was like, wow, okay, I see. But I'm not gonna get into details. It has something to do with
but
the male
now-
dog. We'll just leave it at that.
I don't even know what to do. Google. I'm not Googling that. I'm embarrassed. If I die tomorrow and
that's
then
it.
someone
We're
goes
done.
over my history, they're going to think I'm a freak. I refuse to Google that. I'm just going to have to leave it as one of those things that I'll just never experience and I'll just always wonder about.
Yeah. Me too.
It's
I'm
like
with you, buddy.
threesomes. Like, okay. Anyways.
All right.
On that note.
Yeah. Okay. Well, listen. Great show, everyone. Thanks for tuning in. We'll catch you next week.
All right. Thanks, everyone.
Take care.